think the Fed needs to be market-based and not academic-based.
I think they need to cut before they risk staying higher for too long.
We expect data that will be forthcoming to give them confidence, and it is the Fed's job to take the data pretty much at face value.
The best thing is to just be able to truly look at the data and stand by that, because no matter what they do, they're going to get criticized on the timing.
I'm really not as concerned about the Fed cutting rates. And as long as the economy remains strong, those earnings will be there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Kicking off a new trading week, a fresh month, a clean slate for another quarter, and leaving behind some stellar gains in Q1 and hitting the ground running in Q2. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, an absolutely stacked show for the first hour for the month of April. I'm Jonathan Ferro. Alongside me, Annmarie Hordern, together with Lori Cavasina of RBC for the next 60 minutes. Bramo extending a ski trip by an extra day, needing the extra rest because the week looks like this. Absolutely relentless. PMI and ISM data today. Tuesday, jobs data. Wednesday, ADP jobs and comments from Chairman Powell. Thursday, jobless claims. And Friday, US payrolls to round out the week. And if you want a sneak peek of next week, we've got CPI and bank earnings, Annmarie, kicking off as well. That's quite a start to Q2.
Absolutely, a huge start. It feels like we just heard from Chairman Jay Powell, because we did on Friday. Now he's going to be speaking on Wednesday ahead of the all-important jobs number. Jonathan, the market, the survey, early forecasts are looking for 200,000 payrolls to be added. What is interesting, though, since the start of 2023, those payroll reports have been revised 7 times. So everyone kind of looks at them and says, well, we might get another revision.
Laurie, let's talk about the start of 2023. So January data, boomy. Question we were all asking about February, would it confirm? There's a feeling that it didn't really confirm the boom of January. What are you expecting from the March data that we'll see this month?
So I feel like everything I've heard from companies, just going through all the earnings calls, I feel like things are still pretty strong. Like, I don't feel like there's any sort of imminent cliff that we're about to fall off of. Labor still seems to be pretty tight. Companies are being picky. I don't feel like there's been any big change. I mean, I feel like we're kind of exiting that, kind of point where everyone's saying the economy stinks. We're sort of stuck in economic purgatory. And it's, oh my God, is the economy so hot the Fed can't possibly cut? Like, that's sort of where we are.
You've got to reflect on the data we got on Friday morning as well. We've got the rest of the hour to do so. Ian Shepperton of Pantheon Macroeconomics referred to January as a fluke. After what we've seen over the last month or so, would you refer to the January data as a bit of a fluke?
So our guys have been saying the inflation data, there were some bumps in the road, and I think we sort of heard the same thing from Powell. So I don't know if we can handle too many bumps, but I think a couple of bumps were to be expected.
What was interesting, though, is that it was revised by 0.1% higher when you look at that PCE, which is all important for the Fed. It actually was higher than inflation than they had thought. But Powell almost moved towards Waller here. What he had to say was a reaffirmation that they are in no rush to cut rates.
You'll get Powell Volume 2 a little bit later this week. Let's start this morning with some price action for you. Positive 1/3% on the S&P 500. We're set up as follows. In the bond market, yields just a little bit higher at the long end, virtually unchanged on a 10-year, 420. In the FX market, the euro going nowhere, 107.86 on euro dollar. Coming up this hour, Terry Haynes of Pangea Policy as President Biden builds on his fundraising lead over Trump. Bloomberg's Ender Curran on signs of economic recovery in China. And John Riding of Green Capital ahead of payrolls on Friday. We begin with our top story, setting up the first trading day of Q2. Lori Cavasina of RBC raising her S&P 500 price target to 5,300 from 5,150. The story we see in the data today is that the strong move observed in the S&P 500 so far this year has been deserved. But some of our work suggests gains may be tougher to come by from here, and the stock market needs a breather. So, Laurie, let's get into the upgrade. It's a very subtle, slight upgrade. You've got a range of models to work through. Which one is the more constructive one, and which one is the less so constructive one?
So the least constructive one is sentiment. And, I'll couch that by saying we thought sentiment was a problem for a couple months. Nothing's really changed in the last couple months. We're hanging out at 1 standard deviation above the long-term average on the AAII survey. And that's consistent with kind of a little bit of a breather in the market, kind of flat returns over the next 3 months. And we haven't gotten it yet. The more constructive data points, I would say one is actually our earnings yield gap analysis. If you look when the earnings yield gap is flat and you go back to the late 80s, average return in the S&P is about 13%. So that can get you north of 5,400. If you look at the one that's changed the most since the start of the year, that's had the most bullish move, it's the economic data and the economic model. So to start the year, consensus was looking, I think, for around 1.3% on GDP for this year. 0 to 2% is economic purgatory. Stocks don't do well in that kind of environment. There's this constant, oh my God, are we about to have a recession? Does that sound familiar? That's what we've been, basically hearing the last, year or so, frankly. But now the data is pointing to about 2.1% this year, and 2 to 4%, a very favorable range for stocks. And I think the average return's around 12%, so that's what we've got baked into the model. Your most bullish year, you actually saw, I think, a move about 34% that year. Now, that's not baked into our model, but it just goes to show 2 to 4%, people feel good, and that's what we've just entered.
The character of this rally seemed to shift in the month of March. Energy started to pick up, the banks started to pick up. Tech pretty much did nothing last month, barely got talked about. Do you think that's a sustainable trend going into April and beyond?
I think it is. And, we downgraded tech back in January. We look at median PE multiples when we pick sectors. I know the market is technically cap weighted, but stock pickers, people I talk to, portfolio managers, they're picking individual stocks. And if you looked back to kind of 6-9 months ago, your median tech stock was around the long-term average in terms of its forward PE. And that really shot up at the end of the year and was almost as expensive as the industrial sector, really just one of the worst sectors we saw. So we think you've kind of lost the valuation appeal. And I'm not even talking Bank 7 here, but just of your typical tech stock. And I think things like energy are very cheap, financials are very cheap, materials has been on the move, even utilities had a good end to the month. And that's a sector, a couple weeks ago started looking really attractive on our valuation model. So I think this market wants to rotate, and it's starting to happen.
That's what I was going to ask you, though. We've had a number of false starts. Is this a real rotation?
I think it is. I mean, we're seeing it in terms of so many different parts of the market. Even small caps relative to large caps are trying to make a stand. And that's probably where you could have the most accusations of a head fake, because we keep thinking, it's looking exciting and then it gets knocked right back down. But I think these things in energy and materials really generating some true excitement among people.
Rates seem to drive the rally in Q4. In Q1, rates did not drive the rally. It was kind of bizarre. The nature of what underpinned the move seemed to shift. Can you walk us through the relationship and how it's evolved between what's happened in rate pricing and what's developed in equities?
So we saw a very strange relationship emerge after SVB, where basically if you looked at 10-year Treasury yield moves, it was equating to growth outperformance relative to value. And I think there were a lot of things that drove the big cap tech stocks last year, but one of them I think was better balance sheets, and those, kind of Mag 7, at least some of those names. If you look at like net debt to EBITDA, they basically don't have balance sheets as a basket, whereas the rest of the market, has regular amounts of debt. So last year when we were seeing 10-year Treasury yields move up and Fed fears move up, one of the safety trades that happened was going into big tech. And now I think we're starting to see, sort of a different kind of Fed narrative evolve this year. There's been some rising angst, but still I think the cuts are on the table. Maybe that's going to break. We'll see. But I do think if the Fed can thread the needle here, sorry, that's a tough sentence to say, but if they can thread the needle here and we can sort of get to the cuts, interest rates can come down, they can, the economy is kind of a show me story. We stay above this 2%. I think you'll see things like financials do well, even if interest rates come down a little bit. Typically, you want interest rates to go up for those sectors. But I think if interest rates come down and we don't kill the economy, I think the cyclical rotation is really going to take off.
It's a question we ask a lot. Do banks need higher rates or not? Based on what we've seen, it kind of feels like no, maybe they don't.
I don't think they do. I think what you want is a higher rate environment than what we've had in past cycles. I think you want them to come down a little bit so we can, sort of preserve the economy. I think they've just turned into this kind of very boring trade where they're the plumbing of the economy. And if the economy is humming along, which probably requires rates to level off and come down a little bit, then they do well, but then you have higher rates than what you've had in the past, and that's also good for them. So it's sort of Goldilocks.
So this is how this rally has developed, away from mega cap tech towards energy, towards banks over the last month, and people start to think about the rotation away from large caps and maybe towards small caps. Peter Chi of Academy is going to catch up with us in the next couple of hours, and he's looking for that move in small caps to continue. Is that something you can get behind?
I think that it should. I mean, and shoulda, woulda, coulda. I mean, I've been saying this for a while, but I think certainly if you look at the valuation data, it's middle innings. You're around a 15 times PE on Russell 2000. It tends to top out around 19 or 20. Was down around 11 last year. It's very middle innings. You see the same thing on the CFTC positioning data. You've moved up off of net short levels, and down around 2022, by the way, they were recessionary in terms of how bad they were. So we're back to net long territory. We're at kind of the 3-year highs, not all-time highs. If you look at S&P or NASDAQ futures positioning, you're basically back to all-time highs, or you've been a little bit above them on certain indicators. So I see a catch-up trade in the small caps, and I do think they're a bellwether.
When you're looking at your models, This is all based on inflation moderating.
Yes.
What happens if inflation does not moderate?
I think that that's one of the reasons, frankly, I think things like energy and materials have done so well. Yes, there's some cyclicality there, but there are also inflation hedges to some extent. So I think you'll continue to see certain sectors like that do well. But if we sort of go back to this environment, right, where people are starting to freak out about balance sheets and interest rates are going to move up and, we start talking about hikes again, it could fuel people, to kind of go back to those balance sheet safety trades, which could end up benefiting big cap tech again.
So whether or not inflation moderates or not, energy is a sector to buy.
I think so. I mean, we left it as an overweight at the beginning of the year, and I was a little bit uncomfortable with it, but my analysts liked it. The valuations were cheap. The dividend yields were very high. The balance sheets have been cleaned up. And I just sort of looked at it and I said, all my bets that I'm making on positioning calls are about inflation moderating and the Fed cutting and the economy taking off. What if we're wrong on that? Energy seems like a nice one to have in your back pocket.
Just finally, and you're going to spend the next 50 minutes with us, I'm pleased to say, but what's the difference between irrational exuberance and rational exuberance? How far are we away from one and how close are we to the other?
So I think you keep an eye on AAII. If you get to 2 standard deviations, and we're not there, we don't do it all that often, but I think that would be a sign of irrational exuberance there. And that, we sort of already look like it, frankly, on the CFTC data. We're back to 2020 highs of February. We're back to early January 2018 highs. Those stats make me very uncomfortable. But AAII says we have a little room to go before things get silly.
Does high yield credit make you uncomfortable? Because there's 2 ways of framing it with spreads this tight at multi-year tights. You can basically say it's reflecting strength, or you can say it's reflecting maybe investors taking things too far.
I go towards the strength category, and I'm not an expert on the high yield space. We do talk to our crew at RBC on that desk pretty regularly, and they tell me all the same things that I see on the small cap balance sheet data, which is that things are just, not as bad as they've been in past cycles. Things have really been cleaned up relative to history, and there's some sector differences there as well. But I tend to lead more towards it's a sign of strength argument.
Yeah, you're not alone. Kicking off Q2 with equities at all-time highs and credit spreads in high yield exceptionally tight. Laurie Cavacina of RBC is going to be sticking with us. Equity futures on the S&P positive by around about 1/3 of 1%. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hekes. Hey, Yahira.
Hi, John. Salvage specialists are starting the daunting task of clearing debris from the destroyed Francis Scott Key Bridge in Baltimore. Ports along the U.S. East Coast are modifying their operations to absorb cargo diverted from Baltimore Harbor. The fallout is expected to be largely contained as neighboring facilities with spare capacity tweak their schedules. Turkish President Recep Tayyip Erdogan suffered an historic defeat at the ballot box on Sunday. The lira weakened in early trading after Erdogan's AK party fell behind the country's main opposition, the Republican People's Party, in municipal elections. Support for Erdogan's ruling party is at the lowest on record as the nation battles rampant inflation and the highest borrowing costs since the president swept to power more than 2 decades ago. China's factory activity beat expectations in March, boosting optimism about the country's ability to meet its ambitious 5% growth goal this year. The Manufacturing Purchasing Managers Index rose to 51.1 on Monday. It's the 5th month above the 50 mark, which indicates expansion, the longest streak in more than 2 years. That's your Bloomberg Brief. John?
Hey, Yahira, thank you. Up next on this program, Biden's growing cash advantage.
Stake. Not a joke. I think democracy is literally at stake. We're at a real inflection point in history. Things are changing.
That conversation up next, live from New York City this morning. Good morning.
It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Annmarie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
Live from New York City this morning. Good morning. Welcome to the program. Equity futures on the S&P 500 positive by 1/3 of 1% following 5 months of gains on the S&P 500. Closing out March and closing out Q1 with a gain of more than 10%. for the first quarter. Pretty solid stuff. In the bond market, yields just about unchanged this morning, 420.23 on a US 10-year. Under surveillance this morning, Biden's growing cash advantage.
I think our democracy is at stake. Not a joke. I think democracy is literally at stake. We're at a real inflection point in history. Things are changing. This guy denies there's a global warming. This guy wants to get rid of not only Roe v. Wade, he wants to get rid of the ability of anyone anywhere in America to ever choose. I mean, all the things he's doing are so old. Speaking of old.
Here's the latest this morning. President Biden extended his war chest lead over Donald Trump after raising $25 million at a star-studded Manhattan fundraiser. Trump's still holding on to a lead in most polls, but has less than a third of the funds of his opponent after racking up millions in legal bills. Joining us now is Terry Haynes of Pangea Policy. Terry, you've been saying this for a while, that maybe the former president has topped out. Are you starting to see that coming up in the polls?
Yeah, John, I think so. The way I look at the election really is there's kind of 5 phases of it. The bad news is, of course, this is going to go on for a very long time. The good news is we're into the 3rd phase already. And in the run up to the conventions phase, and in part of that, you're going to see the polls kind of settle out a little bit into what most people think they are, which is instinctively, which is a pretty even race. And in that phase, what you're going to see, I think, is the Biden start making his case about why he should be reelected, why comparatively he's the safer pair of hands. And at the same time, you're going to see Trump's disadvantages, the topping out, happening as well, with a continued split Republican Party and continued independents that aren't for him. He needs both. He needs both of those to be strong for him in order to win. He's not getting it right now.
Well, one big disadvantage Trump currently has, of course, is the campaign funding and the money you can use to campaign around the country. Biden is beating him by millions and millions of dollars. But is the Biden campaign using this money correctly? Where and how should this money be allocated?
Well, two things on that. Well, 3 things really on that, Annmarie. First, I'm not wowed by $25 million in Manhattan with 3 presidents when the entire financial system is basically in the major banks and all the rest are basically down the street. I see people hedging bets there a little bit. Secondly, what Democrats tend to do is pledge money. So pledge versus how much money is actually coming in is a subject that we all need to pay close attention to. Finally, where they ought to put it is in get out the vote efforts. Hillary Clinton had a whole lot more money than Donald Trump 8 years ago, and that counted for nothing, largely because it wasn't allocated well. And Biden is in the position of needing every single vote if he's going to win. So that's their top priority. The other priority they will use it for, frankly, is what gets called candidate suppression, generally making sure the third-party voters are as minimized, third-party candidates, I should say, are as minimized as possible.
We had an update actually on the third-party candidate in terms of a VP pick for RFK. Who does RFK draw from now? Is it going to be Trump or Biden?
Well, I think he probably draws more from Biden, but I think we learned a lot about Kennedy in the last week, and none of it's good for Kennedy. Kennedy, 2 things. One is he basically decided to become a niche candidate instead of a broad-based challenger. That's number 1. Number 2, he had a choice about whether to broaden his appeal or not. He's chosen not to broaden his appeal, and by picking what I think, frankly, is the wackiest vice presidential candidate nominee in American history, and I don't say that lightly. What you've got here is a niche candidate proudly proclaiming he's niche and proudly proclaiming that he doesn't have any money. So that's the motivating factor for him, period. Meanwhile, he's got a problem getting on the ballot, and he's got a huge problem, to your point, getting a message that is going to appeal to a lot of people. So, my 2 cents is Biden, I think, has him down, and over the next 6 months, Biden will go in for the kill and try to wring out any serious challenge that Kennedy might pose.
Terry, this is Lori Calvasina. I get tons of questions on RFK Jr. from non-U.S. investors. The other question they ask me is how confident are we, or what are our expectations regarding Congress? Most folks I talk to outside the U.S. think we're going to have a Republican sweep. And I tell them not so fast, but I'm wondering if you have any updated thoughts on Congress.
Yeah, of course, Lori. Two things. One is that there's a great hunger in the American public for an alternative to Trump versus Biden, but and an opportunity for a third-party candidate, but that's not happening. So I won't repeat what I said earlier, but that's not happening right now. Secondly, in Congress, the word control gets bandied around a lot, and it's the wrong word. You can see this today. There are majorities in Congress, but there's definitely not control. What you're going to get in 2025, I think, is more of the same. The parties, I think, right now are likelier than not to flip, where you get a small Republican majority in the Senate, a very small Democratic majority in the House, but net, what you're going to end up with fiscally and in a lot of other ways is very much the same kind of Congress you've got today that's not going to deal with fiscal issues if people are restive and will continue to contribute to the kind of half measures that we've seen in American foreign policy at the time where there's the highest geopolitical risk in 50 years.
All right, and one more from me. How much do you trust polling data right now? There's been a lot of skepticism around it, and now that Biden's starting to look a little bit better, do you discount that at all, or do you think we can trust the polls right now?
Well, I never trust it, and I would never suggest anybody trust it. But and I would particularly urge people not to look at national polls for president, because they're not only beauty contest polls, but the president isn't elected in a national popular vote. He's elected in the Electoral College, and it will be a he this year. So. He's elected in the Electoral College, so thus the attention to battlegrounds. Generally speaking, the last time polls were pretty accurate on Biden. They tended to undercount Trump slightly. I would look for pollsters to try to attack that a little bit and correct it. But I'd be looking at battlegrounds almost exclusively were I an investor. And would I trust them? No. Will they give you a sense of sentiment? Sure.
Terry, I want to finish on the former president. You've had some, I think, industry-leading thoughts on the former president, A, topping out, and B, making the point that perhaps he's not the candidate he was in 2016 and 2020. Terry, what do you think is changing?
What I think is changing fundamentally is that 8 years ago, he was seen as a change agent, and people were so frustrated they were willing to take a chance on breaking some china in order to have change happen. And this time out, after 8 years, whatever else he isn't a change agent, number one. Number two, the Trump base, I think, demonstrably isn't getting any bigger, and you can see that from primary election data. And thirdly, frankly, people are getting tired of the act. And beyond that, I think you've got a Republican Party that's more than ready to move past him, no matter whether you're a Trump acolyte or not.
Hey, Terry, great to get your thoughts, buddy, as always. Terry Haynes there of Pangea Policy. We started Q1 by talking about Laurie's quote that talking about the election was like staring at the sun. Is it the same in Q2? Are we moving on a little bit?
Well, there's the eclipse next week, right? So people are going to be forcing themselves to, and that's maybe a good analogy for the market, right? I think, I talk to clients and they don't want to be talking about this, but they're getting questions and having to put out their papers and having to start thinking about investment allocations. And I do frankly worry, the question I asked Terry, I worry about the non-U.S. investor who's been setting up for a red sweep. That seems like a pro-U.S. trade. I saw some headline late last week talking about, interest picking up in Europe. If election dynamics are changing, does it cause some of these non-U.S. investors to pull money out of the U.S. and put them in other markets? That's rotation in the leadership, but Is there something else under the surface too? The
struggle for many, I think, is still so early in the year. I think we still need to think about who the VP is going to be potentially for the former president. Politico with this overnight. It's sweepstakes season for Trump. It's not going to end anytime soon. He's going to draw this out apprentice style, which is basically what you said about a month ago.
Absolutely. He's going to want to be the kingmaker. It means that he's going to get a lot more attention, going to get his name ID up, and he's going to float some people and see, to Terry's point, what part of those individuals outside his base potentially flock to his VP.
If you're just joining us, equity futures right now positive 0.4%. Coming up next on the program, China's factory activity beating expectations in March. We'll catch up with Bloomberg's Enda Karen from New York. This is Bloomberg. Kicking off Q2, equity futures positive by 0.4% on the S&P. On the Nasdaq 100, up by 0.6. There's your outperformance on the small caps. Is it real this time? We'll ask that question a lot through the next 24 hours. We're up 0.7% on the Russell. In the bond market, 2-year, 10-year, 30-year. Things just stabilising on the 2-year, basically ending March where we started it, around 460, 459.72 this morning. Yields a little bit lower by a couple of basis points. But the interesting breakout, I think, in the last 30 days or so, the last 4 weeks, has been in the commodity market. Starting to see copper breakout, see the same in crude again overnight into this morning. Gold, new all-time highs, fresh records for gold, up another 0.9%. Copper up by 0.2%. Brent crude's pulling back just a touch by 0.4%. Energy breaking out. Annmarie, we're seeing it in energy equities. Energy stocks on the S&P 500 up by something like 10% in the month of March.
I'm just stunned by Brent crude. People are talking about $100 a barrel. Well, we're not that far away. We're above $85 a barrel on Brent. And Jonathan, when I look at a number like that, this has to be a headache for the White House. Do they need to potentially think of a strategic petroleum reserve pulled drawdown, strategic election reserve potentially, if you're looking at $4 or $5 gallon of gasoline this summer? This is the worst timing this administration could potentially have for a breakout in energy prices.
Let's think about what's behind it first before we get into what they can do about it. Is it just a supply-side story? I think the data overnight, we'll talk about it in just a moment. Signs that China's starting to bounce back as well. Just subtle signs that maybe they're starting to rebound.
Absolutely. So on the demand side, potentially you are seeing this pickup in China. But also on the supply side, OPEC has been ratcheting back all of this production. And we're going to get a JMMC meeting, an OPEC ministerial meeting on Wednesday. Potentially they're going to reiterate, we're going to still keep some of that ratchet back some of that production. They want higher prices, some of these countries. Part of that, Jonathan, has to do with the fact that the supply is coming from the United States of America. Record supply coming out of the United States.
Brent crude right now, 86.66, WTI 82.90. Under surveillance this morning. Busy week for data and Fed speak as well. We'll hear commentary from the Fed every day this week, including Chairman Powell on Wednesday. ADP employment data also coming that day. Another round of jobless claims on Thursday, followed by the main event, payrolls Friday. Bloomberg survey, the median estimate, 200K for the month of March. Laurie, you're with us for the hour, I'm pleased to say. I want to talk about the data. What's more important to you at the moment? Is it this week's payrolls report or next week's CPI report? Because you get the feeling from the FOMC that maybe things are shifting away from CPI and shifting back towards payrolls.
I would say for me, it's still the inflation data, because I think in my mind, you still need to see progress on inflation in order for the Fed to justify starting those cuts mid-year. I think on the jobs data, you know, we've talked a lot about small caps, right? One of the things we've seen historically is that around when you get the negative inflections in the unemployment rate, i.e. it starts to move up, that tends to be actually pretty close to the inflections in small cap outperformance relative to large caps. And it's sort of the idea that these more cyclical parts of the market bake in pain early, and then once you actually get evidence of it in the labor market data, you sort of go ahead and buy it on the discount, right? That you've already priced in all the bad stuff. So I'm a little bit less concerned about the labor market data. I do think, it's kind of bad news could end up being good news for the Fed call. So I kind of have a hard time, and if we don't get the bad news and inflation cooperates, then, the Fed can still cut, right? Like, I'm not convinced they really want to, bang up the labor market in here just for the sake of doing it.
When it comes to inflation on Friday, Powell said you won't hear us overreacting to these past 2 months when it comes to CPI. But what happens if it is not 2 months? And that CPI next week will potentially give us some insight into if it's stickier.
Right, and I think it's fair. And, we've done a lot of work like looking at historical cycles. And if you go back to the 1940s, we did see inflation ebb and flow, right? So just because you've killed it doesn't mean it's permanently killed. So I do think they're right to be vigilant going forward. And, I think this Fed has just gotten so beaten up for letting inflation getting out of hand. I don't blame them for being cautious on the other side.
The big data point of the week is payrolls on Friday into next week. You'll get CPI and some bank earnings as well. I want to turn to this story. Officials in Baltimore are set to open an alternative temporary channel for shipping near the collapsed Francis Scott Key Bridge. This is part of a phased approach as crews scramble to remove debris and open up as much of the shipping lane as possible. The Department of Transportation announcing $60 million in emergency funds going towards rebuilding the bridge. The Biden administration continuing to call on Congress to fund the rest, which is expected to be in the range of hundreds of millions of dollars. Now, we had Terry Haynes of Pangaea just moments ago, Anne-Marie, talking about the difference between having a majority and having control. Who has control over this issue at the moment?
Well, this issue right now is going to be Biden continuing to remind Congress that they need to act. What I would take note of is what Maryland Governor Wes Moore said over the weekend. He pointed to the fact that this will impact a farmer in Kentucky, an auto dealer in Ohio, and a restaurant owner in Tennessee. He's saying this isn't a Maryland, which is right now a blue state. This isn't a Maryland issue. This is a national issue, because this is what the issue is going to be, Jonathan. And yes, the Republicans technically have control of the House, but they can't really get anything through without Democrats supporting.
Laurie, one question we had last week was whether that event was really a challenge overall to the broader story of goods disinflation, which seems to have taken a little bit of a step back in the last few months. How much of a challenge is it?
You know, I think we're going to have to see how it plays out, but it's something certainly you want to add to the list of reasons to be vigilant there, right? And I would say when I think back to our economists, you know, they were expecting some bumps in the road, and I think, you know, goods inflation coming up a little bit more than they expected was maybe a little bit of a bigger bump. So I think it's an important issue on this, you know, specific port. I think we're just going to have to see how it plays out. But I do think it sort of brings the whole infrastructure discussion back into focus, and that has interesting, you know, interesting ramifications down the road. I think in terms of how Biden campaigns, you know, are there some potential, you know, at least he's done something on that front? Does it give them something to talk about? And I think we've all assumed on Wall Street, right, whatever we get out in November, Congress isn't going to be able to do much going forward.
Yeah.
Well, maybe there's an interesting sort of area of bipartisan agreement that's starting to emerge, and there's maybe, you know, some stimulus dollars that might come back into the conversation.
It's a good point. Speaking of bumps in the road, major bumps in the road over in China and possible signs of a recovery. Chinese stocks gaining as factory activity beats expectations in March. The Caixin Manufacturing PMI index rising to 51.1, marking the fifth straight month for expansion and the longest streak in more than 2 years. Troubles remain in the property sector, with home sales dragging for March. The value of new home sales for the 100 biggest real estate companies sliding 46% from a year earlier, according to China Real Estate Information Company. Bloomberg's Enda Karen joined us now to break down some of this data. Enda, let's talk about this. You've got the official manufacturing read. You've got the Caixin manufacturing read. What are the two saying right now, Enda?
They're both headed in the right direction. They're saying the industrial production upswing is looking a bit more firmer in China now, Jonathan. These readings, as you mentioned, both in positive territory above 50, both beating expectations. And when you look into the detail of the two PMI readings, they're suggesting that new export orders are doing well also. So suggesting that there is momentum there behind this export and industrial recovery story. And that gels with the idea that China's exports are also recovering this year. So it is starting to look like the manufacturing and the industrial side of the economy is doing okay. You've mentioned, of course, there's lots of problems elsewhere. I think the big question is going to be whether or not this industrial upswing proves to be sustainable. We kind of had a bit of a false dawn this time last year as well. But right here, right now, for the rest of the world looking back at China, it looks like one positive part of their economy for sure.
And the commodity market is telling very different stories. When you look at copper, when you look at iron ore, copper backs up that rebound in China. Other things as well. Big supply side story there. What is iron ore telling you when you pick that out of the commodity market right now, given the plunge we've seen over the last few months?
It's a curious proxy, Jonathan, because iron ore used to be the 101 for China's economy. Where iron ore was going, China's economy was headed. Last year was a year of doom and gloom for China's economy, but yet iron ore defied all of those expectations, and it was well over $100. This year, of course, the story is meant to be one of China putting more support into the economy. They've set a fairly aggressive growth target of 5% that politically they will want to hit. But as you mentioned, of course, that's not being translated into commodity price or the iron ore price. I think, broadly speaking, there are concerns around inventories, how much stockpiling there is. But don't stray too far from that 5% target. That's a political target. A lot of economists will tell you that even though it's ambitious, the authorities will spend and needs to be done to hit that, and that will have some flow through to commodity markets inevitably.
And when you're looking at these numbers coming out of China and potentially the demand we're seeing because of what's happening in the commodity sector, Is this the resurgence, the coming out of COVID that everyone was waiting for when it comes to Beijing?
It's a good question, Annmarie. I think the consumer side of things is still fairly downbeat there. We know that our colleagues in Beijing report about the ongoing sentiment there remaining in the doldrums, so to speak. We know the real estate story has not turned around either. We know that new house prices, housing demand, that is yet to turn a corner. The bright spot is the manufacturing side and the export side, and the industrial production side. But let's not forget that in itself is stoking tensions too, because around the world, plenty of rival trading governments are now looking at China's exports, doing very well, questioning whether or not Chinese products are being dumped into global markets, and of course whether or not that's impacting their own companies and their own production. So China's industrial recovery and an export recovery could in itself end up stoking more political tensions with key trading partners, not least of course the US in an election year. So I'd say yes, this is a bright spot. It looks like the industrial story is picking up, but we still have a long way to go on the real estate and on the consumer recovery in China.
Well, when it comes to the real estate and the property market, what could China do to help finally prop this up? Because obviously this remains one of the biggest drags in the economy.
It really does. And a lot of, again, observers waiting for this big China rebound have been wondering why haven't the authorities taken more concrete steps to get the real estate story going again? And again, it comes back to what can they do to tackle bad debt? What can they do to go in and recapitalise those banks involved in the sector, those property developers involved in the sector, take over that bad debt, recapitalise them, get them going again, get those projects finished again? They have, of course, been taking incremental steps. They've been bringing down borrowing costs, they've been making it easier to get financing, etc. But none of it has really turned the corner. And I think until they really do solve the property story, until that happens, then it's going to remain as a dead weight on the broader consumer story. And a lot of people, as I've said before, when you look at China's economy, they're looking at one sector and one sector only, and that's real estate, and asking when will that turn the corner.
I'm going to look at a different sector now then. Just to be different, Endra, I want to talk about autos. I cannot think of a more competitive sector worldwide in any country, in any market, than the auto sector in China right now. For a while, Tesla has had to flag higher prices. They've increased. This is how the market's responded. Shanghai-based NIO announced a plan today that provides up to 1 billion yuan, that's about 138 million US dollars, of incentives for drivers of gasoline cars to make the switch. Here's another one. Chery Automobile said it will cover the cost of purchase taxes on selected models, plus offer better trade-ins for customers' used cars. That's just China. And some of those manufacturers are going to bring the challenge to the United States. Can you walk us through how the tension is building between policymakers across the world right now, from the United States to Europe to China?
Yeah, I think there's a view that China really stole a march when it came to electrical vehicles, John. I remember speaking to an industrial executive last year, actually, out of China, from a big multinational company, making the point that really and truly it was during the COVID years that the Western world missed a step, and China's really raced ahead on the EV front, and we're seeing those results now. Like you say, in China, foreign automobile companies used to do quite well. They were competitive, huge market space there, but the shift to the EV space is very much to the advantage of China's homegrown companies there. And of course, now in the global market, we're seeing those tensions, not just in the US, but in Europe. Worries about cheaper Chinese competitors, subsidised Chinese competitors, and how do governments tackle that? And it's absolutely one of the hot-button political topics, not just in the US, as I say, but also in Europe and elsewhere, how to handle and how to compete with Chinese exports of EVs. And by the way, it's not just EVs. As I mentioned earlier, the industrial production recovery story, the export recovery story, that's about solar panels, that's about key tech components as well. There are lots of areas where some analysts are now looking at China and going, wait a minute, are they exporting extra capacity? Are they dumping on world markets here? And what will that mean politically? So this is going to remain a key topic, I think, politically in the months ahead.
Without a doubt. Enda, thank you, sir, for the update. Enda Curran of Bloomberg. Annmarie, it's the front line right now, potentially, for a big tariff war later this year.
Absolutely. We just heard from Janet Yellen speak about this. And to Enda's point, it's not just EVs. She was talking about lithium batteries. She was talking about solar panels. The fact that most economies in the West think China's just dumping them on this market. And what does China do? They go to the WTO and they say it's the United States, which the FT this morning, in their opinion, say is very rich, saying it's the United States who's the problem with their Inflation Reduction Act.
Sort of dripping with irony. I don't know if the control room has got pictures of the Xiaomi SU7 electric vehicle on display in Shanghai, but a little bit later in the programme, if we can get that picture and compare it to the Model 3 Tesla, they look like exactly the same vehicle. Have you seen these pictures?
Not of the Xiaomi, no.
If I'd seen that and told you that was a Tesla, would you believe me?
Yeah, especially right there when you don't see any branding.
Yeah, it's not one.
It's the color, though. I don't think Tesla does that color.
Amazing. The Xiaomi SU7 just sort of really shaking things up in the Chinese market. More on that a little bit later. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief. Here is Yahira Hakez. Hey, Yahira.
Hi, John. For the first time in its 16 years, the Bank of Japan's supply of bonds is set to shrink. The central bank's gross bond purchases are estimated to fall below the amount of maturing debt for the July to September period. The BOJ is speculated to start slowing its buying as soon as this month. It currently holds 54% of all outstanding debt. The expected move likely won't meaningfully reduce the BOJ's stash of bonds, since the central bank is keeping plans in place to offer cheap loans, encouraging banks to purchase debt. A big data breach at AT&T is affecting more than 70 million current and former customers. The telecom company says the data leaked on the dark web and includes personal information such as social security numbers. AT&T says the source of the data is still being investigated, and it's not known whether it came from the company or a vendor. It's not the first issue this year for AT&T. Back in February, it experienced a widespread outage that took hours to resolve and is now being investigated by the federal government. Tesla is increasing the price of its most popular Model Y sport utility vehicle. All three of its Model Y variants are now $1,000 more expensive. The hike was widely telegraphed for several weeks, and China's automakers are piling in to take advantage, offering sweeteners such as subsidies and coupons to attract potential buyers. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on this program, a patient, Chair Powell.
Many forecasters see growth coming down to around 2% this year. That's about roughly what the first quarter looks like. That means that we don't need to be in a hurry to cut.
What's the rush on the FOMC? That question up next, live from New York City. This is Bloomberg. Live from New York City, equities bouncing back just a little bit to start the quarter, up by 0.4%, adding some weight to the recent equity market rally of more than 10%, double-digit gains for Q1. Single name, let's check in on BYD. BYD unit sales, vehicle sales up 46% year on year. The growth here is just phenomenal, up 56% for plug-in hybrids over at BYD. And AMH, this is where the competition is right now in a major way.
Absolutely, and it's why you see the United States potentially adding more, and they're undergoing potentially not allowing China's vehicles to come in. They'll say part of this is national security, but also is the fact that they want to make sure that they can have their own automakers competitive in the United States and China. 25% tariff for a Chinese vehicle to get into the United States. But Jonathan, look at these numbers that's happening in China, and it's why you see all the other automakers having to cut prices just to remain competitive.
Quick snapshot of analyst recommendations on the name: 38 buys, 1 hold, and just 1 sell. Under surveillance this morning, a patient, Chair Powell.
The economy is strong. We see very strong growth. We had growth for last year over 3%. Many forecasters see growth coming down to around 2% this year. That's about roughly what the first quarter looks like. That means that we don't need to be in a hurry to cut. It means we can wait and become more confident that, in fact, inflation is coming down to 2% on a sustainable basis.
Here's the latest this morning. Core PCE, the Fed's preferred measure of inflation, cooling in February, reinforcing bets the central bank will cut rates later this year. We'll hear again from Powell on Wednesday, ahead of US payrolls on Friday. Mike McKee, our economics and policy correspondent, joins us around the table. So, Mike, you were in on Friday. You drew the short straw.
Yeah.
Any big changes on the data going into the weekend?
No big changes on the data. Jay Powell had told us that the core rate would probably come in about 0.3%, and it did a little below that as he forecast, and then it's rounded up to 3. But basically, what we're seeing is inflation is continuing to come down, but it has slowed its progression, and that's what the Fed is looking at. Powell was asked, "Why don't you, cut anyway?" And he basically said, "We don't want to move the markets around. We don't want a lot of volatility. We want to be safe. We want people to think that we're moving in the right direction at the right time. We're going to be careful." And so he just justified it with the part you just heard about how the economy is strong. They don't need to cut right now.
We were talking to Laurie earlier in the hour about the boom we saw in January, waiting to see if February confirmed that or not. It didn't really. Ian Shepardson of Pantheon Macroeconomics saying the spike in January was a one-off. It was a one-off fluke. Is that how you'd characterize it?
No, at this point, it's, yes, a fluke in terms of that extra added, but we're still seeing strength. We're seeing strength in hiring. It's over 200,000 each month. We're seeing strength in spending. The PCE spending numbers came in up 0.8, which was a sort of phenomenal turnaround from January. So we're seeing the U.S. economy running ahead of potential growth, which is a warning flag for a Fed that's still worried about inflation.
I would say, the question John asked me earlier about employment versus inflation in terms of the stats. What do you think are more important in the next couple weeks?
Inflation, I think, is what the Fed is really looking at. The jobs numbers will add to an impression one way or another of how strong the economy is, but there's going to be a lot of data on that for them to absorb, where the inflation numbers are an actual target.
Yeah.
That's what they've been looking at. And I think that's what the markets will look at and push in the direction of, depending on how the inflation data goes.
So one thing that's come up repeatedly in the communication of Chairman Powell, which is why I think a lot of people are asking that question that Laurie just mentioned, is there seems to be this emphasis on the labour market and if it weakens, we'll be ready to respond. What do you make of that shift, if we can indeed call it a shift?
I don't know if it's a shift so much as the Fed, it's an insurance statement. Like, if we are all focused on cutting rates, the market totally focused on cutting rates. If we had a situation where the economy was going into a recession, then we would cut rates much faster. And what he's doing is avoiding using the word recession by talking about the labor market.
Powell on Friday also talked about dividing their critics into now equal-sized parts, basically saying those who think we should cut or those who think we should maybe stay the same or hike. If that's where you are, then wouldn't that show that the Fed is actually at a perfect position?
It should. But, of course, everybody on Wall Street is never satisfied with where the Fed is. It's always the Fed's fault. I never made a bad trade. It's the Fed's fault. And so you do have half the people thinking that the Fed needs to cut, half the people thinking the Fed needs to raise, and you can see that play out on X and the other social media feeds. And so for the Fed, they do feel kind of like they're in a good position because the economy is strong, but inflation is still going down at this point.
Annmarie mentioned the distance between Governor Waller and Chairman Powell perhaps narrowing. What do you make of that? What is the distance between the likes of Governor Waller and maybe President Bostic and the rest of the committee?
Well, I think basically everybody's sort of moving in that direction. The idea that the economy is stronger than they had anticipated is pushing people. We saw with the dot plot that came out in March that a number of people had moved up, and they were not going to be willing to cut. It would only take one more person to change, and you'd have the two dots. So I think if the economy continues along this path, and we have no guarantee it will, that you probably in June would see a dot plot. And then the markets have to recalibrate everything again.
I do wonder, Laurie, just to finish up with you, how different would the conversation have been the other week if we did get the median dot shifting from 3 to 2? Because we were only that far away. We were pretty close to that happening.
Yeah, look, I don't think it would have necessarily been enough to prick this sentiment bubble, our bubblet that we've got there right now. But I think maybe it could have dampened the enthusiasm just a little bit. We have run some numbers, sort of looking at the Fed SEP or even just keeping inflation sticky and no cuts from the Fed. And if we run our valuation model through that stress test, we get to an S&P of like 4,950 to 5,100. So I don't think it would do, if we just take them all out, I don't think it kills the market, to be honest. But it could, kind of flatten us for a bit.
You mentioned the B word, then backtracked a little bit. Can I just bring up that B word, bubble and bubblet?
Yeah.
What's the difference between the two?
Look, I think when you go back to this Mag 7 conversation, is it irrational exuberance? I started in this business back in 2000. It's not silly like that. I mean, look, these companies had the earnings to back up the premium valuations. Those earnings are decelerating. That earnings growth advantage is decelerating. There's less of a rationality to pay that premium multiple, but this is not a stupid market by any stretch.
This equity market has ripped to start the year. Mike, good to see you. Mike McKee breaking down the economy and Chairman Powell. Laurie, thank you for the last hour. Thank you very much. Laurie Cavacina of RBC Capital Markets. Coming up in the next hour of Bloomberg, we'll catch up with Jay Pawlowski of TPW Advisory. He'll be with us around a table for the next 60 minutes or so. We'll speak to Lee Klasko of Bloomberg Intelligence, Norman Rule of CSIS, and Ed Al-Husseini of Columbia Threadneedle. Norman Rule, got to talk to him about the potential, Annmarie, that Israel makes a move into Rafah in the next few weeks.
And potentially get an update on that because Axios is reporting that Israeli officials will be speaking to the Biden administration today. And what we've heard from the White House is that if they go in, it's the way they go in that matters.
That conversation just around the corner. Equity futures right now on the S&P 500, adding to the rally, closing out Q1 at all-time highs and looking to add to it here in Q2. Live from New York City, the second hour of Bloomberg Surveillance. Up next.
Chair Powell will have some communication challenges ahead.
They have a communication issue right now. They're going to have a tough time navigating this because the markets are really dependent on them being dovish.
It's possible that they start to cut and the economy just reaccelerates a little bit.
Our first rate cuts are probably in September.
We're leaning on June for the first rate cut.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Leaving behind solid gains in Q1, welcome to Q2. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. The second hour begins right now. Alongside Annmarie Hordern, I'm Jonathan Ferro, joined together this morning by Jay Pawlowski of TPW Advisory with us through the next 60 minutes or so. If you are starved for Fed speak this week, you are not going to be on a diet, that's for sure. Look at this lineup. Williams, Mester, Daly, tomorrow, Wednesday, Goolsby, Powell, Thursday, Harker, Barkin, Goolsby, Mester, Barkin again on Friday, and a whole lot more. Friday morning, the big one. It's payrolls Friday, the estimate, 200K. Your equity market on the S&P 500 on the first trading day of April, equities look like this. Futures positive by 0.4% after closing out Q1 at all-time highs. In the bond market, your 10-year 420.82. Plenty to talk about this hour. We'll catch up with Lee Klasko of Bloomberg Intelligence as ports on the East Coast scramble to absorb cargo. We'll catch up with Norman Rule of CSIS. With Axios reporting the US and Israel will hold a virtual meeting today, and Ed Al-Husseini of Columbia Threadneedle on why he likes long-end bonds. We begin with our top story, kicking off the second quarter following 5 months of gains on the S&P 500. Jay Pawlowski of TPW Advisory thinks the rally can extend, writing this: we are optimistic not only about 24, but the out years as well, 25, 26. Our analog remains the US 1995 to 1999 period. The difference is this time it's global. Jay joins us right now. Jay, good morning to you.
Good morning, John.
Does the economic data in China back some of that up this morning?
It sure does, John. I mean, I think it's clear to us at least that, and it's not only the data, right? We wrote a piece on Friday, our Friday musings, called Listen to Stocks, Not Vox. And we want to pay attention to what the markets are telling us. And it's not just stocks. It's also credit outperforming the ag, and it's commodities. And commodities, I think, right now are the big tell. Commodities, and it's not just energy. It's not just gold. It's not just copper. It's all of it. It's ag. It's all breaking out. And that is telling us that there is an opportunity and that the global economy, as we've been saying since the fall, is early cycle.
Soft commodities as well, seen it in cocoa. But a lot of people might say that's a supply side story, not demand. How would you frame it?
I would frame it as both, and that's perfect. It's both supply side as well as demand side. And the fact is that most people have not been investing in commodities, and the demand has been weak, and they've been okay. And now we're coming into a point where that lack of investment, which can't be made up quickly, is going to bite. At the same time as a global economy, we think is setting up for a considerable period of good economic news. And that combination and the fact that very few people are invested there, very few people understand that commodities are the best performing asset class in the world year to date. Everyone wants to talk Mag 7. Mag 7, Mag 6, Mag 5. Commodities, people, it's really basic. It's supply and demand. You don't have to figure out AI. It's just simply buying the stuff that people still use.
How much does this hinge on China, though?
Obviously not very much, because China has been a weak story, and commodities have done well. Markets move first. That's the thing that we have to remember. They're forward-looking discounting mechanisms. They know more than you, me, even you, John.
I'm shocked.
And therefore, they move first. And so commodities are, world's best performing asset class, when now people are just starting to think about China. Okay, PMI is better than expected. JP Morgan last week raised their Q1 GDP estimate to 6.6%. Okay, so you're talking about second biggest economy in the world, looking like it's starting to pick up. And that is obviously bullish for lots of things, including commodities.
A phrase we heard repeatedly, I think, over the last year regarding that region, that part of the world, was uninvestable. And I guess the caveat around that is it depends what you're investing in to get exposure to it. There's a great quote in your recent note, and I'm going to share it with our audience, and I want your thoughts on it. We note the discrepancy between the China tech stack, one that will increasingly have all of China to dominate. That's a really important line. Can you just build that out a little bit more?
Yeah, first off, on that uninvestable line, I also wrote a couple months ago, pro tip, when you hear uninvestable, invest. So that's point A, because it can't get any worse. Can't get any worse than uninvestable. But yeah, I think this point about the tech stack is really, really interesting. There are a lot of things setting up to create a big opportunity. And let's remember that markets have already moved in the US, in tech, et cetera. So we want to be looking for the new areas of opportunity. And that's why that multi-year positive framework allows us to go from point A to point B to point C, et cetera. And that's what we've been doing in our model portfolios. The tech stack story, look, we've been trying to freeze China out of the advanced technology. We're doing a pretty good job. They've got the message. They have to build their own. They're now turning around saying, okay, fine, you can't play in our tech space. And therefore, the question is right now, do you want to be invested in a market of 1.4 billion people, growing at 6% per annum, with an e-commerce market that's double the size of the US, 10 times the size of Japan, and trades at a 70% discount? Alibaba trades at 8 times earnings. Tencent trades at 14 times earnings. China overall trades at 9 times earnings. Okay, no one owns it. I think it's a really interesting story. And the segue, flip your Mag 7 into KWEB, which is the China Tech ETF. KWEB can double and double again and still not get to the level it was in 2021, John. 25 to 50. The 2021 high was $101. I mean, that to me is a no-brainer. And we full disclosure, we own it.
Peter Chi of Academy is going to join us later in the program in the next hour. He's put the emphasis on made by China. How important is that phrase going to be in years to come?
Yeah, I mean, I think we're big believers. Our name and our firm, TPW, stands for Tripolar World. Our whole thesis, our framework is regional integration in the 3 main regions of Asia, Europe, and the Americas. All of this stuff is happening kind of as one would expect. Supply chain regionalization, tech stack, independent development. Everyone needs AI. Everyone needs to climate proof. Everyone needs everyone needs electric vehicles and batteries. And these are the things that are driving that regional integration. And look, I think China is in a much stronger position than people give it credit for, because the region that they're in, that they're going to dominate, is ASEAN. ASEAN is the biggest, fastest growing region and will be for the next 10 years.
It's striking that you have such conviction in China when what we continue to hear from Washington is that they're just going to up the ante. Right now, they're weighing whether or not they're going to sanction the chip makers around Huawei's entire production. How much does that concern you?
Yeah, no, there's a race, right? There's a race going on. China's racing to get itself kind of independent, and we're racing to freeze them out of this stuff. And I think the point that we see is that the U.S. trying to freeze China is already in the price. Everybody who doesn't want to invest in China because they're worried about U.S. sanctions is already gone, long gone. And they're not going to come in. Fine. We don't need them to come in. Again, KWEB can double and double again. I'll just take the first double from 26 to 50 and leave the second double to somebody else.
So a 60% tariff wall for Chinese imports doesn't matter?
Yeah, sure, it will matter. Markets will sell off depending on where we go between now and then.
But I mean, if China is going to build within their own ASEAN.
Yeah. I mean, I would look at what China's done over the last 30 or 40 years, and I don't think we'd want to bet against their ability to kind of construct what they need to construct.
So when everyone else said uninvestable, you got bullish. When you say no-brainer, does that make you uncomfortable? What are the risk factors you would acknowledge exist around this bullish thesis?
For China?
Yeah.
Clearly what Annmarie said is one. I mean, if we come out, if the former president wins, which as I've said on this show, I believe Biden will win on a landslide. But if the former president were to win and were to implement the tariff structures that he's talked about, that's clearly going to set the Chinese market back. But by the same token, as we advance to that point in time, China's own internal dynamics theoretically should get better, right? The property market should be better dealt with. The focus on domestic consumption should be moving further down the road. So it's not a zero sum. And how that all plays out, you know, I mean, we have the ability to change our mind and to adjust our positions. And so we'll look at that when the time comes. But I mean, that to me is a big worry because I think everything else is in the price. Alibaba, and no, it doesn't grow as much as it did before, but as the prior guest said, same is happening in the U.S. tech space. Earnings acceleration is coming down. Same as in Alibaba. The other point is that these companies in China are just like the U.S. companies. They're cash-making machines. They are buying back stock. They are paying dividends. And so, you know, 8-9 times earnings, I think the risk-reward is some of the best in the world because the risk is already in the price and the reward is starting to materialize.
I'm sure this morning you've managed to convert a few non-believers for a tactical trade. What's interesting about your call, it's not just tactical, it's not 2024, it's 2025, it's 2026. Why has this been extrapolated out? It doesn't sound like this late cycle story from your standpoint. It feels much, much longer term.
Yeah, exactly, John. And, you know, we put out a piece, our 2024 outlook, back in the beginning of November, so 5 months ago. The title was Surprise, Surprise. We had 4 macro surprises: lower inflation sooner than expected, better productivity growth, return to stability, and early cycle. All those are playing out. In particular, the return to stability argument. Look at the VIX. Look at the move. Look at the Fed. With all respect to the lineup of Fed speakers, I pay virtually no attention to that anymore. That is not the story.
We've just had an
8-minute
conversation, and that's how long it took to mention the Federal Reserve in your whole thesis.
Yes, and that's exactly right.
Why is that?
Because it doesn't matter. The important thing is that the Fed and markets are in sync after being out of sync, right? 6 rate cuts in December, now, and Fed at 3. Now we're both at 3. And guess what? That happened without a ripple of market unease. And that tells me that's one of the things that tells me that this market is a strong market. And so we have, in our view, we're early cycle. We've made a return to stability. The Fed is our friend now, right? Can cut, as you were talking about, with labor worries. The Fed is our friend. The rest of the world is picking up. And so we look at 2023 to 2027, that body of time as being very much akin to 1995 to 1999, where you had productivity-inspired growth, you had lower inflation, you had good earnings growth. The difference, as you quoted, is that this time it's global, and it's global because of this tripolar world materializing in the fact that everybody has to spend on AI, on climate, on semis, on electric vehicles. And so you're getting, in our view, a much more stable globe because you're not dependent just on the Chinese consumer or on the US. You now have 3 centers that are going to be growing independently of each other. And so really the question is, who balances best private and public sector? Because you need both, because these are huge investments, right? These are like, you know, game-changing investments. And so who manages that best? And that's one of the reasons why we like Europe. And you and I have been talking about this for years. But Europe has more experience than any region in getting everybody around the same page. One can argue they didn't do it well and it takes too long. But, you know, look at the U.S. and Congress, right? I mean, no, not really an example of great governance. And look at China stumbling after a really good run. So I look at ASEAN, and China dominates ASEAN, fastest growing region of the world. We want to play there. We look at Europe integrating, being forced by conflict to integrate, right? Multiple countries spending together, raising debt together. So you're going to see that capital market integration. And then we look here in the Americas and we see Mexico, which again, we've been overweight and invested in for 2 years because it is the flagship for the tripolar world thesis. Biggest beneficiary of what's going on in the Americas. We were invested in Poland. You and I talked about that last time for the European thesis as well.
Yep.
And we're invested in China for the Asian thesis. And so to us, it's an exciting blue sky period ahead. And the fact that most people are not there, people have kind of gotten on to the tactical trade. I mean, 27% in 21 weeks. If you're not on the tactical trade, you're probably not working anymore. But, to us, the good news is that we are, we see the process moving for multiple years, and we're still early in that, and others are going to come behind us. We're already double-weighted commodities, and we have been for 6 months. And so we're just moving from point A to point B and onward.
This is some super bullish stuff. Just remind me never to book you for Fed Decision Day. Okay? Jay Pawlowski at TVW is going to be sticking with us through the rest of this hour. Equity futures on the S&P 500 positive by a third of 1%. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Turkish President Recep Tayyip Erdogan suffering a historic beat at the ballot box. The lira weakened in early trading after Erdogan's AK party fell behind the country's main opposition, the Republican People's Party, in municipal elections over the weekend. Support for Erdogan's ruling party is at the lowest on record as the nation battles rampant inflation and the highest borrowing costs since the president swept to power more than 2 decades ago. Salvage specialists are starting the daunting task of clearing debris from the destroyed Francis Scott Key Bridge in Baltimore. Ports along the U.S. East Coast are modifying their operations to absorb cargo diverted from Baltimore Harbor. The fallout is expected to be largely contained as neighboring facilities with spare capacity tweak their schedules. And UPS has announced an expansion of its partnership with the U.S. Postal Service. In a statement, UPS says after an initial transition period, it will become the primary air cargo provider for USPS. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, racing to reopen the Port of Baltimore.
That is the only way to get into most of the Port of Baltimore. And of course, it's important not just to the people and the workers of Baltimore, but to our national supply chains to get that port back up and running as quickly as possible.
That conversation up next, live from New York City this morning. Good morning. Equities doing okay to kick off Q2. Equity futures positive here by a third of 1% on the S&P 500. On a 10-year, just about unchanged, 420.63. Under surveillance this morning, racing to reopen the Port of Baltimore.
That is the only way to get into most of the Port of Baltimore. And of course, it's important not just to the people and the workers of Baltimore, but to our national supply chains to get that port back up and running as quickly as possible. Then you have the process of getting the bridge back up. That's going to take longer, but that work is already getting underway.
Here's the latest this morning. Baltimore's mayor announcing plans to establish a temporary channel for commercially essential vessels to access the Port of Baltimore, as other ports along the East Coast scramble to modify operations and absorb cargo diverted from the city following the collapse of the Francis Scott Key Bridge. Joining us now to discuss is Lee Klasko, the senior logistics analyst for Bloomberg Intelligence. Lee, can you talk to us about how easy it is just to redistribute some of that cargo that was meant for that port and to take it elsewhere?
Yeah, the good news is that the Port of Baltimore it's a large port, obviously, but it's not one of the largest ones in the United States. It's a big player in export coal, and some of that coal could go to the Port of Norfolk. And then it does a lot of business with what's called roll-on and roll-off. So think automobiles, ag equipment, construction equipment. It's specifically stronger in the ag and construction machinery equipment. So that stuff will probably have to move to Philly or maybe New Jersey or Norfolk as well. So you're going to see those types of products be moved. And on an intermodal basis or containers coming in, it's really not a major container port. It is one of the, maybe I think it's number 11 or 10. Obviously, it is big, but that can get easily absorbed in the port of New York or Philly or somewhere else. And again, this is going to be a short-term kind of disturbance until the channel is clear. It's really unknown how long that's going to take. We've seen estimates between 6 and 12 weeks. I'm a little bit of a pessimist, so it's maybe north of 12 weeks for that to happen. And once that happens, freight's going to return, and the impact's going to be felt on supply chains, but it's not going to be a major blow like we were dealing with during the pandemic, or even what's going on. It's going to be less of an impact of what we're seeing from the Suez Canal and the Red Sea crisis that's going on with the Houthi rebels.
This temporary alternative channel on the northeast side of the main channel that we're hearing from the captain of the port, and this is what they want to try to establish, they talk about that this will be for commercially essential vessels. What does that mean exactly? What is deemed essential?
It's something that's a fantastic question. I don't know the answer to that. I would imagine it is products such as healthcare products and things that we need, not things that we want. But I don't know how they would find those needles in the haystack of a container ship carrying 8,000 TEU. So it might be very hard for them to do that. I think what they're going to do is just try to find some priority for some freight that needs to get in and out of the port more on an expedited basis. But I think it remains to be seen about what that actually means or entails.
Hey, Lee, Jay Pulaski here. How much do you think the focus on getting the port up and running plays off of the ability of Pennsylvania, I believe, and Governor Shapiro to reopen 95 in such a quick period of time? It seems to me like U.S. Government officials are much more focused on being able to use these crises as demonstrations of ability to get things done rather than huge problems that are going to take forever to fix. Is that your sense as well?
Yeah, I mean, listen, in a time when we can ever get things done is a great thing. Unfortunately, this is a reaction rather than something being proactive. The highway that stretched along the Francis Scott Bridge had something like 33,000 cars or vehicles on it every day. It's kind of small relative to I-95 or the BW Parkway. Those highways are going to see more traffic. It's not going to really impact that much truck traffic per se in terms of those trucks having to go to different routes, because at the end of the day, the port's going to be closed for a while. So the impact on those on highways is probably not going to be that meaningful. It's obviously going to impact the people that use the bridge every day more so than, call it, truck traffic.
Lee, we're catching up with you more and more. The conversation started in the last few months about Houthi rebels attacking commercial shipping vessels in the Red Sea. Then the conversation shifted to the water levels in the Panama Canal. Where are freight rates? Because freight rates started to pick up, and there was a sense, and we talked about it, that maybe that was temporary. Has it been temporary?
Yeah, so our big thesis has been that, these dislocations are short-term in nature, and a lot of them are, create really knee-jerk reactions to rates. Trans-Pacific rates are down about 50% from last year. Transatlantic rates are up around 100% from last year. The transatlantic rates were just really off of weak levels. What we're seeing on the Trans-Pacific side, they peaked, back during the pandemic, and it's been a slow reversion to the mean. The reality is supply-demand dynamics are not favorable to shipping rates. There's a lot of supply coming onto the market. The order book is very large relative to demand. And so, we should see continued deflationary pressures as it relates to the liner rates. Now, when you're looking at the truckload rates, this is a totally different market. But, spot rates right now are very depressed, and they're pretty much poised to kind of rebound, but we're still bouncing along the bottom. We expect spot rates to kind of start inching up higher with a little more meaningful direction sometime here in the second quarter. And so that should be good for trucking companies like the Warners, Knight Swifts, and Schneiders of the world.
Lee, this was awesome. Good to touch base with you. Lee Klasko there of Bloomberg Intelligence. We reflected on this last week. Is everything just super fragile, or do bad things just keep happening more often?
Well, it feels like things are fragile and bad things are happening at a short period of time. What I find interesting is that a lot of these ports had peak capacity during COVID, and they started to lessen that back, so they can absorb some of these shocks we're seeing like we are in Baltimore.
Coming up on this program, we'll continue some of this conversation. Axios reporting the US and Israel will meet virtually today as Prime Minister Benjamin Netanyahu vows to press on in Rafah. Norman Rule, the former senior US intelligence official, joins us next. Live from New York City, this is Bloomberg. So Q1, double-digit gains on the S&P 500, more than 10%. Let's just say that was largely unexpected. Q2 kicking off things this morning. Equity futures positive, 0.25% on the S&P, up 1/3% on the Nasdaq. The Nasdaq 100 in March did basically nothing. I don't think enough is talked about that. And Jay Pawlowski, you've mentioned it. The action happening elsewhere, energy, the banks, not on the Nasdaq 100.
Yep, absolutely right, John. And I think it's the way the market is moving, right? People are looking for opportunities, and things get exploited so quickly these days, right? It's like, boom, everybody gloms onto something, and it pops. Like, I mean, it was tech, right? In our global multi-asset model, the things that worked over the last month or so, it's copper and it's energy. Our copper miners are up almost 20%. Copper. Right? So it's that type of marketplace where things go from point A to point B.
I'll do something I don't normally do. I'm just going to skip the bonds board and go straight to the commodities board. And we can look at copper, crude and gold. So copper right now is right through 8K, very close to 9. I want to talk about gold. What do you think is happening with gold as we look at another all-time high this morning and gold is up by 0.9%? What's underpinning that? What's happening there?
Yeah, no, definitely gold is breaking out, and it's just a symbol that multiple parts of the commodity complex are breaking out at the same time, suggesting it's a really strong move. People are underallocated. You have supply-demand issues taking place. And I think for gold in particular, what's interesting is that the biggest buyers of gold, John, are other central banks. Okay, so this is another example, I think, of the U.S. kind of sanctions policy maybe shooting itself in the foot a little bit. You already see a little bit of dollar erosion, and that's a longer-term story. People want to be reserves in other things. You see every day talk about taking Russian assets and using them to rebuild Ukraine. Maybe a good policy move, but it makes other central banks and reserve managers think about how much do they want to have exposed there.
You said the Fed story wasn't particularly relevant, or rather wasn't relevant at all to your equity market call. How relevant is it to this? Because there is a sense in some quarters. We had Mohammed Al-Erin around the table with us following the Fed decision, and Mohammed was talking about maybe this Fed accepting a higher inflation rate, going beyond just a 2.0. Do you think that's starting to be baked into the commodity price as well?
Well, I think for gold, it's really rates, right? And so the fact that we've got the peak, we're likely to have rate cuts, that opens the door for gold to start to move. One of the things that we're waiting to see is for the dollar to roll over, and then that gives commodities another leg and gives other parts of the world, like emerging markets, which we like a lot, an opportunity to start to move as well. So that's the second part of the story. Gold is moving first, partly because of central bank ownership, partly because we are giving rate cuts. The rate cut cycle that we anticipate this year, John, will be the most synchronized since 2008. 10 of the 11 major central banks in the world are going to cut. The Swiss National Bank just started the G10 last week. So that door opens, that gold is an opportunity to move higher.
Guessing that one of the 11 is the BOJ,
yes,
right?
Yeah.
Which will maybe hike rates later this year, perhaps. That currency pair, dollar-yen, looking earlier this morning, has done virtually nothing all morning. Gold right now on my screen, positive by about 0.9%. Under surveillance this morning, no shortage of Fed speak this week. Fed officials currently slated to speak at a total of 19 events. The headline will be comments from Chairman Powell on Wednesday after he reiterated that the central bank isn't in any rush to cut rates anytime soon. On the data front, plenty of insight into the labour market this week. JOLTS and ADP reports coming ahead of payrolls on Friday. The Fed speak, AMH, you're going to hear from Williams, Mester, Daly, Goolsbee, Powell, Harker, Barkin, Goolsby, Mester again. The list goes on and on and on through the week.
Yeah, and how much does it matter given the fact that we already heard from Powell after PCE, and we're going to hear from him before jobs? I wish actually he was speaking Friday yet again after the jobs report, because that's really what the market is going to be building up to this entire week. And our survey is expecting 200,000. And then, of course, next week, inflation, which Lori Calvasino says really that's more important.
I'm not even going to ask Jay what he thinks about the Federal Reserve. I'll just go to the next story. Tesla shares higher this morning after the company revealed price hikes on Model Y cars. All three of its Model Y variants are now $1,000 more expensive. The company's website displayed the higher prices for the model in both the United States and China, with moves in China particularly significant as it runs counter to a number of incentives and price cuts EV makers in the country are offering. This was flagged before. I imagine, Jay, it was to encourage people to buy it ahead of the price increase. The competition here, though, is fierce. I shared some of this a little bit earlier. I think it's worth going over again. NIO's come out and announced a plan today that provides for up to $138 million of incentives for drivers of gasoline cars to make a switch. Another Chinese automobile company, Chery Automobile, came out and said it will cover the cost of purchase taxes on selected models, plus offered better trade-ins for customers' used cars as well. Can you think of a more competitive market right now than the Chinese auto market?
Well, what I love about that, John, is that they're communists. How does that even work? Communists are the best capitalists there are in China EV. It really is interesting. And to us, we named Tesla one of the first tripolar world companies a couple of years ago when they had production in Shanghai, production in Europe, production obviously here in the Americas. Now you see BYD doing the same thing, right? Production obviously in China, setting up a plant in Hungary, want to set up a plant in Mexico. And so this is the way the world is working. And Tesla BYD is really an interesting fight to see who is going to work, who's going to be successful. And Annmarie, to your point about, we were discussing earlier about China and China's ability to kind of compete in a block, you know, BYD is like the leading edge, right? So if BYD is doing fine in China against Tesla, in their competition, John, they are pricing at the same as an ICE car. So electric and ICE, same price. That's going to be a killer for basically the rest of the automakers around the world.
Look at the numbers this morning. They're doing more than just fine, and not just on VEVs. To John, to your point, this hybrid push that actually a lot of people are looking at. When it comes to Tesla, though, this price hike, yes, it was flagged, but also it comes as they earlier this month told employees they're not going to produce as many. Remember, they went from a 6.5-day work week to a 5-day work week. Less cars, they have to pay for it somehow. Jack up some of the price.
Jay, you've pointed to a story that I think, though, is going to be incredibly complex in years to come. The difficulty of dominating three of those markets simultaneously. How hard is that going to be? Because we get the sense now that governments are basically determined not to allow BYD to succeed domestically. This isn't a push that's coming from manufacturers. If you speak to the car companies, at least this is what they say on the record, so you decide whether it's what they truly mean behind closed doors as well. On the record, they're willing to compete. What you hear from government officials is they're not going to let BYD compete in places like the United States. So when you think of your tripolar world, are there companies that can be successful across three different regions simultaneously?
Yeah, that's going to be the challenge. And I think the best companies are going to be those companies that are able to do that. And BYD is a great example. So they are already thinking that maybe they're not going to be able to put a plant in the United States. So they've licensed their battery technology to Ford. So they are participating through Ford. They hope to be able to put a plant in Mexico and export into the United States. And I think the challenge is going to be the driver is the climate. And we need to deal with climate, and we need to hit our numbers on the climate. The Chinese have dominated the renewable product line, whether it's solar, whether it's wind, whether it's EV, whether it's battery. And so how do you square that? You know, we need to do this many EVs in order to hit our carbon neutral targets. The best, cheapest EVs are Chinese, and therefore, what do? I think that is a policy question. But to us, the reality is that the world is moving in this tripolar process, and these companies are the ones who are really leading the charge.
One to watch. It's a big story this year, that's for sure. Let's turn to our next story. The US and Israel set to meet virtually today to discuss the Biden administration's alternative proposals to an invasion of Rafah, according to reporting from Axios. The meeting following comments from Israeli Prime Minister Benjamin Netanyahu saying they're preparing to move more than 1 million Palestinian civilians out of Rafah before launching an attack on the southern Gaza city. Joining us now to discuss is Norman Rule, Senior Advisor on the Transnational Threats Project at CSIS and a former senior US intelligence official. Norman, can you talk to us about alternatives? This conversation is an important one. What do you suspect the alternatives are?
Good morning. Well, first, the nature of the talks themselves tell you something about the alternatives. These are not direct military-to-military conversations. This is an interagency team led by the National Security Advisor, so this is not tactical operations. Second, as you look at the Rafah target itself from the Israeli perspective, they don't need to work in the tent areas. They need to focus on the inner city where the tunnels are located and Hamas leadership and the remaining 4 battalions are located. So the question becomes, how do you move portions of the population to open up areas of the city, likely in a staged progression, to allow Israeli forces to come in and achieve that mission? The challenge, of course, is that Hamas's primary defense is to fight from behind civilians because civilian casualties produce international political pressure that restrains Israel.
If this meeting today is not tactical, is it just political? And in that sense, has the pressure the Biden administration has been putting on Netanyahu, has any of it worked and materialized?
Well, the political pressure placed by the Biden administration and its partners on Israel certainly is genuine, but it is meant to ensure that the Israeli operation, which the U.S. supports in theory, is conducted in a manner that does produce the fewest civilian hostages. That will be very challenging. So the U.S. challenges itself how to be involved in this process enough to save lives, but not so deeply involved that it's part of an operation that inevitably will involve casualties, if only because Hamas propaganda will claim same.
Well, Norm, how serious should the Israelis be taking this political pressure from the United States when over the weekend the Washington Post reported that they quietly signed off on another round of warplanes and bombs headed to Jerusalem and Tel Aviv?
The weaponry provided to Israel was primarily consisted of dumb explosives. They're high intensity, but are critical to bringing down tunnels. And if married with precision technology, can be used in a way to minimize civilian casualties. Israel needs this. The Biden administration can slow these deliveries. And Israel also needs this to work against Iranian operations in Syria and Lebanese Hezbollah. So it is unlikely the U.S. is going to cut aid, but the U.S. can constrain that aid, which shapes Israel's operational capabilities.
If we're looking at future aid, though, going to Israel and potentially some of these constraints, do you think this administration would sign off on what some progressives in their own party want, which is strings attached to some of those weapons going to Israel?
It's unlikely only because of the complexity of that statement. For example, if the strings attached are that Israel withdraws from Gaza, then we have to recognize that Hamas not only wins, will take charge of Gaza, will push out the Palestinian Authority, and that leaves, again, the Hamas state in Gaza, possibly within the West Bank itself, on the border of Jordan, which is a somewhat fragile state. So the United States has a complex geopolitical dynamic in which it must engage, but its concerns over civilian losses are genuine.
The president appears to have set a red line. I say appears because he still has the luxury of backing away from that if he wants to. Norman, what do you think the consequences actually are if Israel crosses that perceived red line? What are they? What does the US do? What kind of change in policy would it generate?
I think the idea of a red line is difficult to understand because the U.S. does support operations against Hamas, does support Israel eradicating Hamas. It's just how that's done. So as long as Israel doesn't conduct an operation that results in massive civilian casualties, that appears to be consistent with U.S. policy. If Israel does cross that line, I think you would see a large pause in aid. We saw in 1991 a significant dispute between the Bush administration and the Israeli government over a $10 billion aid package, and that aid was withheld at the time until the then Israeli government made concessions. I think you might see something like that in the future. In any case, the U.S.-Israeli relationship has been really challenged and even stained by this event, and will take some time to recover.
Certainly strained over the last few weeks, even more so. Norman, wonderful to get your perspective, as always, on this story. Norman Rule there of CSIS. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. OpenAI is expanding its global footprint. The artificial intelligence pioneer is set to open an office in Tokyo, according to sources. It will be the company's first location in Asia and third international office overall after opening branches in London and Dublin last year. The ChatGPT maker has been in talks to raise funding at a valuation of at least $100 billion. A big data breach at AT&T is affecting more than 70 million current and former customers. The telecom company says the data leaked on the dark web and includes personal information such as social security numbers. AT&T says the source of the data is still being investigated, and it's not known whether it came from the company or a vendor. It's not the first issue this year for AT&T. Back in February, it experienced a widespread outage that took hours to resolve and is now being investigated by the federal government. In the March Madness tournament, the North Carolina State men's team continuing their shocking run with a win over Duke Sunday night. The 76-64 victory has the 11th-seeded Wolfpack back in the Final Four for the first time since it won the national championship back in 1983. And in the women's tournament, college superstars Caitlin Clark of Iowa and Angel Reese of LSU facing off tonight in a rematch of last year's national championship game. That's your Bloomberg Brief. John?
Yahira, thank you. This is where the man from Duke says he doesn't care about basketball. Is that right?
More than I do about the Fed, John. Definitely a disappointing outcome, but I'm really focused on Duke football. So,
of course,
best of luck to the Hoopsters. But
I knew that.
We're football focused here.
I have to do this every year just for my own evaluation, given where my manager went to school. Boiler up. I think we do that every single year. Boiler up. Final Four. Final Four. I was messaging Rachel yesterday. I was like, semi-finals. She was like, no, it's called the Final Four. It's not the semi-finals. So I'm adjusting. Up next on the program, Chair Powell sticking to script.
Growth is strong right now. The labor market is strong right now. And inflation has been coming down. We can and we will be careful about this decision because we can be.
That conversation up next. Jay's going to find a way to weigh in on the Fed Speak. Live from New York, this is Bloomberg. Equities on the S&P, silence around the table. Futures positive, third of one. So excited about sport and baseball in Massachusetts, apparently. Equity futures on the S&P right now, positive a third of 1%. Yield just about unchanged, 420.82. Under surveillance this morning, for some of us at least. Chairman Powell sticking to script.
We don't see it as likely to be appropriate that we would begin to reduce interest rates until the committee is confident that inflation is moving down to 2% on a sustained basis. But if that doesn't happen, then obviously our rate policy will be different. We can hold rates where they are for longer. Growth is strong right now. The labor market is strong right now. And inflation has been coming down. We can and we will be careful about this decision because we can be.
Here's the latest this morning. Friday's inflation data coming in line with the Fed's expectations, keeping the central bank on track to start cutting interest rates in June. Ed Al-Husseini of Columbia Threadneedle writing this: I suspect we are underpricing how much easing is likely to be necessary in 2025 to offset the normalization this year. But I'd like to see front-end yields overshoot more to the upside. I like owning long-end bonds with this backdrop. Ed, I'm pleased to say, is with us around the table. Ed, good morning to you.
Good morning.
Before we get into the yield curve, there's another quote I want to use of yours, and it's on the framing of the Federal Reserve's policy. I think this is really, really important. It's a framework question. Here's the quote. As the Fed moved from looking for real rate settings consistent with inflation declining towards 2% to making rate normalization contingent on signs of economic deterioration, how would you answer your own question?
Yeah, not yet. I think the focus remains firmly on inflation, and the judgment, and we saw Chairman Powell reiterate that last week, is that monetary policy settings are in a good place. Once we start focusing on unemployment and the lack of an increase in unemployment, the bar for starting those rate cuts starts to go up significantly higher, and we're not quite there yet.
Labour market on Friday, payroll's just around the corner, CPI next week. Given what you've just said, is CPI still the bigger number versus payrolls on Friday?
Most definitely. Most definitely.
And it's going to be for the time being, for the next few months, next quarter?
I think that's right. And this is the struggle the Fed's having at the moment is they're so focused on short-term data, and disproportionately at the moment it's short-term inflation data. It highlights a couple of things. One, there isn't really a great framework for forecasting inflation in this environment. We're feeling our way out in the dark, and that's what the Fed's reiterated a number of times for us. Second, are real rates in the right place? And this is kind of the core question. Are monetary policy settings okay, or are they being eroded by the fact that markets are doing really well and financial conditions have eased? They're shying away from that later question and really just myopically focusing on short-term inflation data.
Ed, I got two questions for you. One, if you look at the Fed funds rate versus the core PCE, one could argue that monetary policy is super tight, tightest since 2007. We know what happened at that point in time. I'd love your thoughts there. And then the second question, at our firm, we're bullish on commodities. And I know you like the long end of the curve. Do you have a commodity view built into that? Like if commodities go up 10 or 15%, broadly speaking, does that make your long end buy recommendation less attractive?
Yeah, let me work backwards. I think commodity space, it's really interesting at the moment, largely because growth has surprised to the upside so consistently over the course of the past year and a half, right? I don't remember the last time we had negative growth surprises. I think it was 2022, maybe perhaps the middle of 2022, when surprises were negative. And if you look at just the span of the last 6 months, growth expectations for the U.S. have doubled, right? I think the Bloomberg survey has gone up from below 1 to in excess of 2%. This is a fantastic backdrop for the commodity space. And a lot of this recovery has been led globally by manufacturing stabilizing and now potentially accelerating. And we saw that with PMI data coming out of China over the weekend. So a pretty decent backdrop for commodities. I think where it starts to disconnect a little bit from the Fed strategies, that those commodity prices really have not fed into underlying inflation in a meaningful way, right? Oil prices are back up to close to 12-month highs at the moment, and yet inflation has continued to systematically decline. We're now in sort of the 2.5–3% space, so we're squeezing out that last bit. So I think fantastic space for commodities. Remind me your first question.
Yeah, just the spread between Fed funds and
Fed
core
funds.
PCE, real money, very tight, or real rates.
The question is, what's the benchmark for that, right? And this is where we get into the sort of the neutral rate conversation for the Fed. What's the rate that the economy can sustain? And it clearly looks like that rate's drifted higher, at least relative to where we were pre-COVID.
So that raises questions about the limits of potential easing further down the road. You mentioned that in 2025. We heard from Andrew Bowles at PIMCO at the FT last week, and he likes duration also, but maybe looking at the longer end abroad, outside the United States. Two reasons: one, supply, another one was the limits of easing here relative to what you might get from elsewhere, the ECB, etc. How would you think about that, the US versus what's happening abroad?
Yeah, I would say, I mean, the key differentiator here is really the domestic growth story here in the US. We're a large, relatively closed economy. We've not been impacted to the same extent by, let's say, the energy price shock in 22. And the strength of the dollar is disproportionately negative for those economies. And that we've seen that in the manufacturing story in Europe. Where I think it gets more interesting is the judgment call of whether we can continue to surprise growth to the upside, right? This gets into the productivity story. Has something in the economy reshuffled in such a way that we can grow faster post-COVID? My bet is fundamentally not likely, and therefore some of the growth that we've brought forward in the course of the last couple of years is likely to leak out of the system and give us room to cut. And I think duration here in the U.S., again, in part because the starting real rate's a little bit more attractive.
Jay, do you take the other side of that?
No, I like that because I think that extends the story, right? We talked earlier, we have a view that the 2023 to 2027 period is akin to the 95 to 99 period in the U.S., where we have several years of solid economic activity ahead of us. And what I'm hearing you say is that we're set up such that rates can be cut in 2025. And I think that backdrop just kind of reinforces a pretty positive outlook, John, and probably reinforces the non-U.S. play, because that should lead to dollar weakness. I guess that would be my next question for you. You know, what's the view of the dollar here, given your expectations? Because our view is that that's going to be the second leg for the commodity kick, the second leg for EM, et cetera.
Meaningful dollar weakness, in my mind, really begins with an aggressive rate easing cycle, right? Some of the mid-cycle adjustments that we're currently pricing for this year anyway, let's call it 2 cuts or so, probably not going to do it. We're going to need to do a little bit more. The outlier event that tends to backstop the dollar is a risk-off environment, right? That is very, very difficult to predict. Risk asset valuations right now are a little bit on the rich side. What knocks that off course? I have no idea, right? We might have to wait for that a little longer.
Ed, this was super thoughtful stuff. It's good to catch up with you.
Thank
you, sir.
Thanks for
Ed Ahusani there of Columbia Threadneedle, together with Jay Pawlowski at TPW. Jay, thank you, buddy, for the last hour. Enjoyed this.
Always a pleasure.
Got to keep doing
Thank
this
you. Yeah?
every single month.
Love it.
Equity futures right now on the S&P 500 positive 0.25%. In the next hour on Bloomberg Surveillance, Peter Chair of Academy, former New York Fed President Bill Dudley, Greg Dacko of EY, and former Fed Vice Chair Randy Quayle. A whole lot more still to come. The third hour of Bloomberg Surveillance up next.
I think the Fed needs to be market-based and not academic-based.
I think they need to cut before they risk staying higher for too long.
We expect data that will be forthcoming to give them confidence, and it is the Fed's job to take the data pretty much at face value.
The best thing is to just be able to truly look at the data and stand by that, because no matter what they do, they're going to get criticized on the timing.
I'm really not as concerned about the Fed cutting rates. And as long as the economy remains strong, those earnings will be there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Ending Q1 with equities at all-time highs and high-yield spreads at multi-year tights. If Bramo was here, she'd say the following. What could go wrong? Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. Alongside Annmarie Hordern, I'm Jonathan Ferro, together for the hour with Peter Chair of Academy Securities. Lisa's going to be back with us tomorrow morning. Let's get straight into Q2. The lineup. We really do hit the ground running this week. This is what we're looking for. Monday, today, PMIs, the ISM. Into tomorrow, the JOLTS report. ADP on Wednesday, together with Chairman Powell speaking. Thursday, jobless claims. Friday, the payrolls report. The median estimate in our survey, 200K. And if you want a sneak peek of next week, CPI and bank earnings on deck. A lot still to come. Equities kicking off Q2. Look like this on the S&P 500. Futures positive by 0.25%. Yields higher by about a single basis point on a 10-year, 421. In the FX market, pretty much unchanged on a euro against the dollar, 107.85. Coming up this hour, Peter Chair of Academy Securities on why the market could be headed for a big rotation. Former New York Fed President Bill Dudley saying last year's bank runs could happen again. And former Fed Vice Chair Randy Quayle on the Fed's path forward. We begin with our top story this hour. The equity market rally continuing after the S&P posts its fifth straight month of gains. Peter Chair of Academy Securities saying he's ready for a rotation. He writes this: I'm so sick of hearing about the Mag 7, Fab 4 or whatever. His words, not mine. And that it is time. At the time of the 22nd all-time high for the S&P 500, I'm looking for anything to steer me away from that. The Russell 2000 suddenly outperforming is interesting. Pete joins us around the table for more. Pete, good morning to you.
Yeah, good morning.
Is it more than just interesting? Is it the real deal?
You know, I'm not 100% sure, because I've been kind of thinking about this market as really AI. Anything that's kind of been deputized into AI has been driving the market. But for the last week, all of a sudden, the Russell 2000 is a little bit better. I've liked the energy sector in particular. And I'm wondering now, people are starting to say maybe banking's okay, commercial real estate. You know, biotech's had its ups and downs, so we could see a rotation. Unfortunately, I think this time, unlike November where we saw the rotation with strong gains for both, this time I think we might get tepid gains in the Russell 2000 and a small pullback in the NASDAQ 100.
Yeah, your words, and I think they're interesting, they're important, powerful words. Is the rotation more about losing less or making more? Which one is it?
I think it's going to be about losing less right now. I think where a lot of the froth is, where things are overextended, is really in that NASDAQ 100 type stocks. And if you look at it, it's really unchanged in about a month, month and a half. So it keeps coming up, and maybe it's a new high, but barely, unlike maybe the S&P. So I think there's room for that to kind of topple a little bit as people question, have we overextended on AI? Listen, AI is going to drive the future. The questions to me are you getting enough value at today's technology level, at today's pricing? And I'm not sure everyone's getting that. So if you see a pullback there, it's going to be the Russell 2000. Plus, people are looking where to put money that's not at all-time highs or really high PE ratios.
I'll ask a question to you that I asked to Lori Calvasino, who is seeing potentially the signs as well of a rotation. We've had so many rotationary false starts. What makes you have the conviction that you think this could be it?
Well, again, I think we go back to the fall. We had a 22% rise in the Russell 2000 versus an 11 in NASDAQ 100. So that's, a 10% outperformance. That's the sort of thing I'm looking at. I think people are getting tired with the same story. Okay, I've already fully committed to AI. Where am I going to put my new money? And you start looking for value. You start putting money elsewhere. You've seen energy do very well. Mining's doing well. So I think that starts leading the way. If banks can stabilize and we get bank earnings next week, the regionals do well, that really pushes nicely there. And that's what I think drives it.
Jay Pawlowski was also talking about energy. You like mining. He also liked soft commodities like agriculture. So you're just seeing the entire commodity landscape push higher?
I'm more in the hard commodities. I think energy's been really the big focus because how I've been looking at it is it feels like we're finally understanding if we want sustainable energy, we have to build up sustainable energy more rapidly. So that's going to require a lot of commodities. But we also, for the first time, I think, understand we need real traditional energy for the next 20, 30 years. So that's going to be built out. So that's why I think that hard commodity energy is better. I'm not as sure about the ag stuff, though I would not touch cocoa, for example.
Are you doing this through equity exposure or directly through the commodity market? Which one?
I prefer the equities, I think. Again, our story for the last 2 to 3 years has really been that the energy companies of the future are the energy companies of today. People kind of tossed them out the window a few years ago saying, oh, it's all going to be about wind farms. It's all going to be about this. And people are realizing the traditional energy companies have the resources to provide energy today, but the skills to figure out how to provide energy in the future. I think that's where the big bet is still.
Started to see that in March, started to see energy pick up, I think, by about 10%. Really solid month of gains for energy stocks on the S&P, likewise on the banks as well. You've got an interesting take on the Federal Reserve. We've heard echoes of this over the last week following Chairman Powell. While they haven't officially changed their target, they seem to be willing to ease monetary policy, even while inflation remains closer to 3% than 2%. What is 100 basis points between friends? What does it change in this market?
So I don't think it changes that much. I think, again, we saw the market priced out. I think we started the year at 6 rate cuts. We went down to as low as 2.5. And the market did fine because it's all about growth. So I think we can manage around that. But I think there is a little bit of froth, and maybe it's deserved, as you see Powell kind of shift his narrative to things that allow him to cut, right? No one's talking about the market doing the work for him. Remember back in November when yields were high? Now the market's undone all the work for him, and no one wants to talk about that. So it feels to me they're constantly looking to pivot to some excuse to be easy, which I understand. If you're the person in charge of the Fed, you probably don't want to be the one who drives us into recession, so you're probably slightly biased easy, and now he's figured out a new rationale for that.
Do you think the Fed is actually working against the market, or rather the market's working against the Fed? Because the Fed seems comfortable with stocks at all-time highs and credit spreads that are super tight.
I think we're okay-ish right now. I think there's kind of a decent balance, right? No one's going crazy. We're not talking about 4 or 5 cuts this year. I think we are rightfully saying it's probably the end of the hiking cycle. Though, having said that, right, as some of this data comes through, and if I'm right on some of the commodities, we might see a bit of a resurgence. And the other topic that's coming up a lot is as we're saying, oh, inflation's coming down. I think people are questioning, did we ever really manage to monitor inflation for the last 3 years? Are we heavily understating? Because you go into the stores and it doesn't look like things are up 3 or 4% per annum. It looks like they're up 10% per annum. So I think people are questioning some of the actual starting level from this decline.
If the Fed is trying to find any excuse, to your point, potentially to cut, what could they use, say, in June? Say they really want to cut in June, but inflation is still on this path where it's not exactly where they want to be, like the end of last year, but it is moderating. Is that enough?
I think it could be enough because I think, one, they'll just say, listen, it's long lag times and we've got to get a little bit ahead of this. And I think behind the scenes, if they can avoid cutting in September or November right into the meat of the election, they'd prefer to do that. So I think you're much better off if you want to get 2 cuts done early this year, you do it June, July, let the markets kind of adapt with that, and then the next one maybe comes in December if we're still there.
John asked a question earlier to a lot of our guests. What's more important, the payrolls number on Friday or inflation next week?
I think it's ultimately the payrolls. I think the market's been driven much more by the growth in the economy, and really it's about the spending on AI. Are companies benefiting from AI? Are the AI companies growing as a competitive? And so we've had
the Fed.
I think for the Fed, it's probably going to be the jobs number. I think they have to look at that. But even then, I think they're in the mode that they're going to close their eyes and say, it's all good enough. We can cut once or twice.
It's funny you say that because that was my sense of things as well, asking the question. That's not the answer I got. The answer I got still repeatedly was that CPI was important. Ed Hosseini of the Columbia Trade Needle was with us just moments ago, and he was talking up CPI being more important than payrolls for the next several months, maybe even the next few quarters. What I'm hearing from Chairman Powell is that he could be willing to move earlier if you see something happen with the labour market and deterioration. What do you make of that, just in terms of the shift in emphasis, if we can indeed call it a shift?
One of our theories coming into this year had been that in 2023, he was happy to cause a recession. I don't think it was his first choice, but if you got a recession, that's fine. There is no way he wants to create a recession in the election year because that almost hands the incumbent a loss. So I think he is going to be much more cautious about creating a recessionary, and that's where I think the balance is tipped this year, too. It's much more about jobs and far less about inflation.
You introduced politics. You think he's worried about the incumbent losing?
I think he wants to be as independent of causing an election result as he possibly can.
Okay.
And so keeping the economy on a steady flow and not turning into recession is probably better for him.
Thinking about politics so he doesn't have to think about politics?
Kind of.
Okay.
Well, your timeline basically says they need to move so they don't look like they care about politics. But the fact that they would be moving so they don't look like they care about politics, they do care about politics.
It's probably pretty hard when, one, you've got Elizabeth Warren writing letters, your boss is the president, and then you've got the former president who is very, active on social media and happy to point out any problems. So get this out of the way, bear the pain, and hopefully, fingers crossed, have to do nothing September, November, and let politics take care of itself.
So a big part of this conversation where we started it was the big rotation and whether it was about making more or losing less. And you said potentially it's about losing less, which should prompt the next question. What part of the market right now, which part of the market do you think is most vulnerable? Because the way we're set up right now, in commodity markets, we've got things that are at multi-year highs. We've got gold that's at an all-time high. In credit, high-yield spreads are at multi-year tights. Equities at record highs. What do you think is vulnerable at the moment? Where are the losses going to be?
So I think it's going to come really from the outperformers. So I think the NASDAQ 100 is the most susceptible. You're going to have some of the individual stocks where now, on individual stocks, they trade leverage ETFs, which seems insane to me, why we would have a single stock leverage ETF, yet it's there. I think it's over $2 billion in market cap. So people are trading this.
It's there because people want it.
Yeah, and it seems a bit like meme stock type stuff. So I think your meme stock, however you pronounce it, but I think those things start pulling back a little bit. The overall market can do well. I think credit's fine. I think credit's very good. I do think, separate from everything else, people should be allocating more to whether it's credit in terms of munis, agency debt, corporate debt, than treasuries. I think if you're running a big bond portfolio, I like the extra spread that you're getting, and you have technically better governance at these entities than now you do out of D.C.
Interesting. Pete, you're going to stick with us. That raises a question about treasuries. We'll hit a little bit later on the programme. Peter Chair of Academy Securities. Equities right now pulling back just a touch. Still positive on the session by 0.1%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. A massive salvaging effort is underway with crews clearing debris from the destroyed Francis Scott Key Bridge in Baltimore. This as ports along the U.S. East Coast are modifying their operations to absorb cargo diverted from Baltimore Harbor. The fallout is expected to be largely contained as neighboring facilities with spare capacity tweak their schedules. UPS up in pre-market trading after announcing it's expanding its partnership with the U.S. Postal Service. In a statement, UPS says after an initial transition period, it will become the primary air cargo provider for USPS. This coming as its rival FedEx says it was unable to reach an agreement to extend its contract with the U.S. agency. Gold is hitting another record on bets the Federal Reserve is getting closer to cutting rates this year. The precious metal jumping as much as 1.6% from Thursday's close. Strong buying also coming from central banks, particularly in China. Consumers there also driving up demand amid ongoing problems in the world's second largest economy. That's your Bloomberg Brief. John?
Just a series of all-time highs there over the last month or so. Yahara, thank you. Up next on this programme, preventing the next banking crisis.
We feel very good. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
That conversation just around the corner, live from New York. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Annmarie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
Looking forward to having Lisa back with us tomorrow morning. Going into payrolls on Friday. The estimate in our survey at the moment about 200k. Just got the number from Goldman. That email just sent out in my inbox. We forecast that payrolls rose 215 in March. The unemployment rate fell to 3.8%. Plenty more coverage on that throughout this week. Equities at the moment on the S&P 500 just about positive by 0.1%. 0.13% on the S&P. Yields creeping a little bit higher in the last 30 minutes or so, up 3 basis points on a 10-year, 423.59. Under surveillance this morning, preventing the next banking crisis.
Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession. And so there'll be difficulties, and we're working that. We feel very good. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
The latest this morning. 1 year on from Silicon Valley Bank's failure, worries linger over another crisis in the financial sector. Former NY Fed President Bill Dudley saying another bank run could happen, writing this. Regulators have been focused primarily on increasing loss-absorbing capital at the largest U.S. financial institutions. Much less attention has been paid to the problem that precipitated last spring's banking crisis, vulnerability to sudden depositor withdrawals. I'm pleased to say that Bill is now with us for more. So, Bill, let's start there, and then we can sort of lean into monetary policy as the conversation progresses. Let's start with the stress of the spring of 2023, 12 months ago. What was behind that, and what haven't we done to address it?
Well, the problem was that one bank, Silicon Valley Bank, which was very poorly managed, failed. But the problem was the contagion that then generated a whole bunch of other banks. And what we saw at the time was that depositor outflows were much faster than anyone had anticipated. It's the most rapid demise of a bank that we've ever seen in terms of money going out the door. The regulators have been focusing on increasing capital on the biggest banks. They have not been focusing on how to deal with that contagion problem. We need to really build up the Fed's lender of last resort function so it's credible to uninsured depositors so they don't run. And one way to do that is to require banks to pledge collateral to the window, to the discount window of the Fed, equal to all their runnable liabilities. So if uninsured depositors know that's the case, they don't really have a reason to run. It's the contagion issue that I think which was so striking and powerful that we need to address that was evident last March.
Bill, do you think the keys to answering that question, though, are at the Fed or are they elsewhere? I'm thinking more about deposit insurance. Is that something we need to change and maybe change quickly?
Well, you could raise deposit insurance, but that's, first of all, going to require congressional legislation. The other problem with deposit insurance raising is it basically increases what economists call moral hazard. People are going to be less careful. You know, we saw during this S&L crisis that banks, S&Ls with lots of insured deposits go out and takes lots of crazy risks. So I think addressing contagions through the lender of last resort function, I think, is a better way to go to guard against that kind of risk taking.
Yeah, my question, I guess, would be, while the Fed is somewhat reactionary, my sense is they learned from 2007, 2008 to act more aggressively, much more quickly. Does that kind of fix the problem, or should there be more being done preemptively?
I like to fix problems ex ante rather than after the fact. And we saw a very awkward result in March of 2023 when we had this issue of the systemic risk exception that could only be invoked after a bank failed to insure all the depositors. And so Janet Yellen and Jay Powell are basically saying the banks are strong and resilient, but they couldn't actually guarantee that all depositors would be insured because it only can be invoked after a bank fails and only on a case-by-case basis. This is a way of reassuring people that a solvent bank is not going to be subject to runs that deplete its cash. Basically, the reason why people run is it's very inexpensive to run. It doesn't cost very much to run. And you really run if there's some risk that you're not going to be paid off. If banks have enough collateral pledged to the window to cover all their runnable deposits, then there's no reason to run, and you sort of dampen down the risk of contagion right at the start.
Is there any risk we've pushed a little bit too far in terms of some of the regulations where we're forcing banks to have more and more treasuries, which did cause some of the problems in Silicon Valley Bank, but it's also really turned the private credit industry around, where that's where more and more people are turning to as banks are somewhat restricted or uncomfortable with the current regulations?
Well, you're on a very important point. And one way you could respond to what you saw in March of 2023 is dramatically raise the liquidity buffers that banks have to hold. But if you do that, then they have to hold a lot more securities, can make less loans. They become less like banks. They can't perform their intermediation role. So I think piling on more and more regulation on banks is not really the way to go, because it makes banks less competitive, as you noted, with the non-bank financial sector.
Bill, did the deregulation of 2018 have a meaningful impact on the failure of the likes of SVB?
Well, if SVB would have been more tightly regulated if you had had the rollback in terms of the size, the asset size, where you were subject to tougher prudential regulation. So that contributed. But I think the big surprise to people was how fast this all happened. Typically, it's taken several weeks for a bank to go from trouble to actually fail. Silicon Valley Bank, it was a couple days and they were gone.
Bill, let's do a sprinkle of monetary policy as well. Add that to the recipe. Can I talk to you about everything else? Because we're talking about bank crises, and I'm just seeing equity markets at all-time highs and credit spreads at multi-year tights. How do you think this FOMC is thinking about what's happening with financial conditions, beyond just what they look at, looking at equity markets, looking at high-yield spreads? Because when you hear the chairman talk about financial conditions, he says they're tight. When you hear market participants talk about them, Bill, they say something else.
I was surprised by his answer at the press conference to the question about financial conditions. He really didn't want to talk about financial conditions, where in the past he's talked about financial conditions a lot. And he actually implied that the financial conditions were still tight. I don't see that. Stock market's up very dramatically. Credit spreads are narrow. Bond yields are down. Mortgage rates are down. Since end of October, we've had a dramatic easing of financial conditions. So right now there's a bit of a battle going on. The long legs of monetary policy versus the easing of financial conditions. And, if you're trying to figure out what the impulse of monetary policy right now is, you have to figure out what the balance is between those two things. My personal opinion is monetary policy is not really exerting that much restraint on the economy. And that's why the Fed has been on this path of having to stay higher for longer. I think another aspect of it is that, so-called R-star, the neutral monetary policy rate, is probably higher than what the Fed officials are assuming. It's very interesting to me is the Fed thinks that the federal funds rate is going to go all the way back to 2.6%. That's their immediate projection in the long run. But if you look at the market expectations of where interest rates are going to go, they have them coming down to about 3.6%. So there's a 100 basis point gap between where the market thinks the Fed is heading and where the Fed thinks it's heading. And in this case, the Fed is actually a lot more optimistic about the scope for rate cuts over the next few years.
Yep, 3.6 and climbing. Some people talking about 4. Bill, this was wonderful. Thank you, sir. Great piece on Bloomberg Opinion today and on the Bloomberg Terminal. That was the former New York Fed President, Bill Dudley. Let's talk about it, Pete. The spread between where the Fed thinks we're coming back down to and where this market thinks longer-term neutral is.
I think the Fed has a long history of being overly optimistic on things, whether it's transitory, whether it's inflation, long-term averages. So I think they are in the business of being somewhat optimistic. They rightfully probably believe their policies are going to work, so they're going to get what they believe. I would bet against them in some of this case.
Do you think there's a difference, though, between what they believe and what they want to publicly express? Because I do think if they start coming out and flirt with 4%, then it could run counter to what they're trying to achieve.
I would say when they did the dot plot in December, it seemed legit, and all of a sudden you had all these cuts. It felt like they communicated a little bit and said, hey, let's not go crazy on the cuts this time, and they had a much more narrow band in terms of it. So I think it's everything out of the Fed is a job-owning or a messaging tool as well. So I think you get what they want to believe mixed in with what they really believe.
I just get the sense they've been wrong about so many things over the last few years, as we all have been, because it's been a very, very difficult cycle to read post-pandemic. That this isn't even a topic that they're ready, prepared to engage with at the moment. Is that your sense of things as well?
Yeah, and again, I agree with you that they've had an incredibly difficult job. So every once in a while you get out here, and I'm always at risk of you're bashing the Fed, saying it's at risk of political. I think they do the best that they possibly can. They're very smart people. It's a difficult economy. You have all these geopolitical connections. And the one thing I think economists get wrong probably more than anything else is, to me, starting conditions matter. So we're always trying to look at these historical things. Okay, well, 20 years ago, historically, this happened, but China was emerging. Right now, China and us are friction. Technology's changing. We're going through deglobalization. So I'm not sure how well these models work in a world where the starting conditions are changing dramatically. And I think the starting conditions right now are as negative for the global economy as we've seen in a long time.
Is that a low bar for upside surprises then?
You know, I think except we've gone through all those upside surprises, and I think everyone, to me, probably the biggest disconnect in the economy is people still want to believe it's globalization and China's working with us.
Yeah.
I'm on the other side of that.
OK, we'll continue this conversation. Pete's going to stick with us through the next 30 minutes. Joining us around the table, Greg Deco of EY on his expectations for Chairman Powell and US payrolls later this week. Live from New York City, equity futures just about positive by 0.1%. This is Bloomberg. Beginning Q2 in positive territory on the S&P, positive by 0.1%. Right now on the Nasdaq 100 up by about 0.2. On the Russell up by about 1/3%. Just a little bit of outperformance there. It was bigger earlier in the session. I want to turn to the bond market. Peter Cheer's got thoughts. I can tell you about the long end of the curve. Up 4 basis points this morning, 423.78. Pete, you've got to tell me, your theory is, the big thesis, later this year supply reasserts itself. Why?
You know, I think we go back to all the stories that drove us to 5%, right? Supplies there, dysfunction in D.C., foreign buying smaller. Japan's finally easing. It was the most hawkish. It was the most dovish hawkish move ever. But you see all those things playing together. And I think commodities are going to continue to be a good story. And we haven't talked about it yet today, but when you start looking at all the things that are going on, not just with EV, but AI, the energy usage is actually increasing in this country. It's probably the first time that, in quite a while, that we've had, on a national basis, energy increases in demand. And it's largely EVs, AI related, the data centers. I think that's going to be a continuing story. So if you get that sort of inflationary pressure at a base level, I think that's going to push on yields, and I don't see that changing. So the front end's going to be controlled by the Fed, so I think steeper yield curves are, I guess, at this point, less inverted. I'd like to see 2s10s get back to zero.
Hold on a minute. Let me get into that, because you mentioned a lot. AI, which a lot of people would say is great for productivity, you're saying it's going to be really bullish for energy, and that's going to be producing high yields. Can you just develop that a little bit further? Yeah, so the amount of energy being consumed by these data centers is very high. If you look, Amazon bought a facility that's powered by a nuclear generator. There's a lot of shifts where people are looking to locate these data centers where cheap energy is. So I think you might see some geographic shifts where people do business, how it's all going to be managed. But the amount of data that's being processed and used is growing exponentially with AI. That's creating this huge demand for utilities and energy away from oil, et cetera. EV, same sort of thing, right? As that market grows, it's been slowing, but it's still a growing market. You're going to have more and more demand for electricity. I think that's going to push energy prices higher across this country. And again, most of our energy is still, traditional sources, so it's great for all the commodities. That is going to be the downside of AI, at least in the near term. And unlike, say, crypto, where some people talked about the same sort of issue with crypto, crypto could go global. I think people are so much more aware of the risk of having your data center not in the US or Canada, someplace that you can trust, that you're not going to be that shift. You're not going to see data centers pop up all over the globe because people are becoming more and more concerned. Why is my data in that country? Do I trust it in that country? I want it domiciled here. So I think that story of national security data centers helps the energy market a lot. Okay, so what do I want to own?
Again, I think you want to own a bunch of the commodities. You want to own the hard commodities. You want to own the energy. We are in the midst of this kind of rebuilding our society, how it changes. A lot's going to be domestic. I think that's going to create a underlying inflation pressure, not huge, but there is going to be that inflation pressure, and that's what you want to own as we kind of become more independent again across the board.
Nothing happening in foreign exchange can rival this conversation we've just had, but I'll check in on the euro for you. The euro against the dollar, 107.80, negative about 0.1%. Heard from the Austrian central bank governor a little bit earlier over in Europe, talking about the ECB going before the Federal Reserve and saying the European economy is growing at a slower pace than the US. That could mean that our price dynamic weakens more. I think that basically is in line with consensus going through 2024. Under surveillance this morning, the US and Israel set to meet virtually today to discuss the Biden administration's alternative proposals to an invasion of Rafah, according to Axios. The meeting following comments from Israeli Prime Minister Benjamin Netanyahu saying they're preparing to move more than 1 million Palestinian civilians out of Rafah before launching an attack on the southern Gaza city. I want to talk to you about what the generals at Academy are telling you about this, Pete. What are they saying?
So I think right from day one, we said this was going to be a very difficult thing. And our generals compared this Fallujah, which was a very difficult battle for us to win. And we had it much easier because the civilians had already been taken away. So you knew that most of the people there were hostile combatants. And unlike you've seen in Gaza, there was not the tunnel system. So none of this, unfortunately, is surprising that it is that difficult. I think it's probably a good step if they can move the civilians out. But if Israel is intent on destroying these as fighting forces, it's going to be a long and probably brutal process, unfortunately.
Well, that's what I wanted to ask you, what these generals are talking about. If they're able to remove the civilians, which pretty much Biden has made that at least a condition, a red line condition for Israel to go into Rafah, how long until Israel can say, it's victory, we've gotten rid of Hamas?
You know, I think when we talk about it, you can maybe do bombings, you can do things, but the only way to know whether you've cleared it is you literally have to go door to door, kicking in doors, checking out, is this house clear, and block by block. So it is a very slow process, especially if you have tunnels and things like that, so people can shift around. So it is not going to be easy. Even once you think maybe victory is achieved, it will potentially take months to go through and truly clear it out. So any hope that this is going to be a short-term resolution or in quickly and solved, I think is out of place. So that's why we think this is lasting longer. And one reason I remain so worried that we are going to eventually drag Iran into this, and that is going to really jack the prices of oil higher.
That a risk or a base case?
For me, I think it's almost a base case. It just feels that, again, you've watched what's going on with the Houthis, right? They have been very successful. We've launched attacks against them, but they are still attacking shipping, right? They have become very good at what they do. They take relatively, unsophisticated weaponry, they move it around, they hide, they launch, they disappear, and we're spending $1 million missiles trying to shoot down $10,000 drones. It's not a very economic process, and they're very good at this. So unless something changes that we strike fear back into these countries, or these proxies, this continues, unfortunately.
So what does that look like? Just sort of build that out for us a little bit more. A continuation of what we're seeing, tension with proxies, or their direct involvement?
I think it continues tensions with proxies, and we would like to keep it that way, I think, as long as possible. Again, Iran's only selling 3.5 million barrels a day, but that is a significant part of the keeping oil prices lower, right? If you take that down to 1 million, probably oil goes back above 100. So no one wants that coming into election year. So I think everyone, again, is like, let's keep this to proxies and play it even if we really know there's more involvement.
Fascinating. Fascinating. Let's turn to our next story. A busy week of Fed data, Fed speak and data for the Fed. Commentary from the Fed every single day this week, including Chairman Powell on Wednesday. ADP employment data also coming that day. Another round of jobless claims on Thursday, followed by the main event, payrolls on Friday. Greg Dacko of EY saying this. Overall, the US economy is gently decelerating due to more scrutinous consumers and business leaders in a high cost and high interest rate environment. Inflation stickiness is a risk, but not our base case. Greg joins us now for more. Greg, what's interesting about this, and good morning to you, sort of runs counter to what we heard from Bill Dudley about 10 minutes or so ago. You think we are sufficiently restrictive? You think we are on that glide path towards 2% inflation? Why is that?
Well, I think we are seeing some signs of deceleration, especially in the labor market. It may not be the retrenchment that was once feared, the fear of a recession, a rapid rise in the unemployment rate, but we are seeing labor demand ease, whether it's the quits rate or the hiring rate, whether it's the pace of job growth. With the revisions last month, we were talking a month ago about the potential noisiness in the data. We saw it in the revisions. We are seeing also wage growth momentum easing. All of those factors point to a gently easing U.S. economy that puts more pressure on consumers when it comes to spending.
So what would you do? Would you cut in May, cut in June, not cut?
Well, I said last month that I was a May guy. I think it's more likely now that we're going to see the Fed ease in June. I think given what we saw in the March economic projections, in the March dot plot, we have a number of policymakers that are still leaning on the hawkish side. We know that the dot plot was very close to essentially moving back to 2 rate cuts over the course of this year. We think that the onset will be in June, that there might be actually some signaling in the policy statement from from a negative policy statement saying that the committee will not consider easing monetary policy before to saying the policy committee will start to ease once it sees sufficient confidence that we're moving in the right direction.
Yeah, and that's interesting because, one, I always like to be a contrarian. The start of the year seemed easy, right? They were pricing in 6 or 7 cuts. Now we're down to this 2, 3. I'm kind of torn. Which is wrong? Is it going to be fewer or more? Or do we have it right for a change?
I think the volatility is very interesting to note because we are in an environment where we're seeing that every data release is scrutinized with too much attention, in my opinion. And the noisiness in the data that we saw both in January and in February, some echoes of the January volatility in the data, means that there are rapid repricing that are happening on a day-to-day basis. That is not a normal environment. What we should see is as the data starts to stabilize, we're going to see markets and the Fed realign towards a more gradual easing of monetary policy. And I still would expect about 3 rate cuts over the course of this year. I don't buy the story that inflation is entrenched, nor the story that the economy is reaccelerating and that is going to feed into higher inflationary pressures.
One place where it's not noise and it's real is the rise in commodity prices. How much can that hurt the Fed and as they try to, have this soft landing?
Well, in the past, we used to say that commodities prices were transitory, right? But that's become a bad word. So we are in an environment where because inflation is higher than the Fed's objective of 2%, we are seeing these pressures on the commodities price front lead to potentially some tighter Fed policy down the road. It's not just the Fed, it's the ECB, it's the Bank of Canada, it's other central banks around the world that are affected by these higher commodities prices because they put higher pressure on inflation. So if we are to see an environment where commodities prices generally continue to push up, that will lead to higher energy price inflation and will lead to higher headline inflation, which is going to be a key concern for the Fed that is still keenly focused on getting inflation sustainably, and that's the important word, sustainably down to 2%.
Some people don't buy that after Chairman Powell's performance in the news conference, so I'd love your thoughts on that because I imagine they run counter to that conclusion. Some people believe that maybe this Fed's willing to tolerate higher inflation, which is why we had gold running across the bottom of the screen at all-time highs, while there is this conversation about maybe gold going even higher and starting to price in maybe 3% inflation for a little bit longer. This is what Pete's been talking about in the last hour. Why are those people, including Pete, why are they wrong?
Well, I don't think it's being wrong. I think the starting conditions, as you were saying earlier, are very important. We are coming from above the 2% target when it comes to inflation. So, yes, it is true that we will see more time before we get back down towards that 2% target. But because we are starting from above that target and because monetary policy is fairly restrictive at this stage, this environment where you're seeing moderating economic growth, more pricing sensitivity, less pricing power, does invite the Fed to gradually ease monetary policy. Not do so very rapidly, but gradually do so and focus on core inflation, which has been a key focus of the Fed. We're seeing core inflation move down towards 2.5%, which has been this key pillar of attention for Fed policymakers. And I think we will continue to do so as the economy gently cools.
In terms of surprises, one thing I see, the market seems to view that the slowing Chinese economy might be very good and provide deflation. What I don't think gets talked enough about is India's rapid rise and the potential for an inflation or commodity type boom there. What surprises do you see either that would create a big, inflation spike or deflationary?
I think we have to distinguish the cyclical inflation developments from the structural inflation developments. From a cyclical perspective, we are seeing slowing growth in the U.S. We're also seeing fairly moderate growth across the globe. That is disinflationary in the short term. In the longer run, we have some factors that are likely to be more inflationary. We have an environment that is deglobalizing. We're seeing supply chain shocks, just like we saw in Baltimore. These types of events in the past might not have that big of a consequence, but add them to the Suez issue, the Red Sea issue, the Panama Canal issue, and you have all the regular ingredients that push up structural inflation, the aging of the population, Gen AI and capital investment that's going in there. Those are all inflationary, will likely lift inflation over the 2% target, which is one reason why I think the Fed may consider adding a band around that 2% target, because 2% might be too precise. We might need a band to have that wiggle room in terms of monetary policy.
What kind of band are you talking about? 2.5 or 3%?
Well, we don't know, but the Fed is going to be implementing its new revision of its new framework. The framework that was put in place right before the COVID crisis was perhaps done so at the worst possible time. But we are likely to see, I think, some kind of wiggle room, perhaps 1%, around 2%, so from 1.5% to 2.5%, which would offer more flexibility for policymakers.
I've got to ask the question, if they do that, does it make it even harder to hit 2? If they start to entertain the notion that maybe they'd overshoot by 100 basis points, does it make it harder to get down to 2?
Of course, you don't want to be moving the goal line or the goalpost closer when you're losing by 10-0.
Yeah.
But you do want to consider that once you have achieved at least some form of being close to that 2% target. So that's why I think this is not a story for 2024. This is a story for 2025. Once we are, at the end of this year, closer to that Fed target of around 2%.
Interesting. Greg, thoughtful stuff. It's good to see you as always. Thank you.
Pleasure.
Greg Dacker there of EY. Let's get you an update on stories elsewhere. Here is your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. AT&T down in pre-market trading after the telecom giant said the data of more than 70 million current and former customers was leaked onto the dark web. This includes personal information such as social security numbers. AT&T says the source of the data is still being investigated, and it's not known whether it came from the company or a vendor. It's not the first issue this year for AT&T. Back in February, it experienced a widespread outage that took hours to resolve and is now being investigated by the federal government. In the March Madness tournament, the North Carolina State men's team continuing their shocking run with a win over Duke Sunday night. The 76-64 victory has the 11th-seeded Wolfpack back in the Final Four for the first time since it won the national championship in 1983. And in the women's tournament, college superstars Caitlin Clark of Iowa and Angel Reese of LSU face off tonight in a rematch of last year's national championship game. Formula One owner Liberty Media will buy Motorcycle Racing League MotoGP World Championship in a $3.8 billion deal. Liberty takes control of the league by buying exclusive rights holder Dorna Sports from Bridgepoint and Canada Pension Plan Investment Board. The deal may draw scrutiny from antitrust regulators given it'll merge two influential sports racing businesses. Liberty said it's funding the deal with a mix of cash and debt and expects the transaction to close by the end of this year. That's your Bloomberg brief. John?
So basically, we're going to get another Netflix show, but this time it's about MotoGP, right?
Potentially. What I
Okay.
find interesting is that Liberty will not be the first company to actually own them both. A private equity firm actually owned both of them first, MotoGP and F1. And guess what? The EU anti-regulator said you have to break it up.
Let's see if it's different this time. Up next on this program, the balancing act for Chair Powell.
Right now, there's a bit of a battle going on. The long legs of monetary policy versus the easing of financial conditions. And my personal opinion is monetary policy is not really exerting that much restraint on the economy. And that's why the Fed has been on this path of having to stay higher for longer.
That conversation up next. The opening bow, the first trading day of Q2, 42 minutes away. Equity futures right now positive by 0.1%, up by 0.14% on the S&P 500. Yields climbing higher by 3 or 4 basis points, 423.59. Under surveillance this morning, the balancing act for Chair Powell.
Right now, there's a bit of a battle going on. The long legs of monetary policy versus the easing of financial conditions. And my personal opinion is monetary policy is not really exerting that much restraint on the economy. And that's why the Fed has been on this path of having to stay higher for longer. The Fed thinks that the federal funds rates can go all the way back to 2.6%. That's their immediate projection in the long run. But if you look at the market expectations of where interest rates are going to go, they have them coming down to about 3.6%.
Here's the latest this morning. Fed Chair Jay Powell set to speak again on Wednesday ahead of the US payrolls report on Friday. Powell staying on message last week, saying the Fed is in no hurry to cut rates after a string of hotter than expected inflation prints to start the year. Joining us now is the former Fed Vice Chair, Randy Quayle. Randy, great to catch up with you, sir. Fantastic to get your thoughts on a major issue. A conversation we've been having now over the last week or so is whether this Federal Reserve is beginning to drift towards accepting a higher inflation rate. Is that your sense of things, or would you push back, sir?
No, I don't think that's either likely or consistent with the Fed's communication. Just before this inflationary surge started, the Fed went through a comprehensive review of its monetary policy framework, meetings all over the country. It took the course of a year. And as part of that process, the Fed reaffirmed the 2% inflation target as part of the framework. It would be quite...
I believe we might have lost that connection to Randy Quarles just then. And Pete, you had thoughts. I know you did. This is a big debate right now and seems to be very split. And what you heard there in the early indications coming from Randy is that he did not agree. This was still about 2%. So why are you somewhere closer to 3 when they're sticking with 2?
One, they seem to change their attitude. If you go back right before we hit COVID, we had inflation under 2%, and we finally were getting above 2%. But at the time, they were saying, well, we are looking at multi-year averages, so it's fine to run hot for a period of time. So I think they change their case sometimes to allow them to be easing, right? So that point we were going above, they said no. We went to transitory. Everything was transitory, 4% transitory, 5% Then we reacted. So again, they seem to create messaging that allows them to position for the easy side.
Yeah.
And right now, that feels the messaging we're getting, that, yeah, we're at 2.5%, but we think we might get to 2% so we can start cutting. And even if we don't, we're still going to cut for a little bit.
This is purely observational from my standpoint. It's not a judgment about what I think the Federal Reserve is going to do or not. I think the people who believe that it's closer to 3 now, I think observed Chairman Powell and what he said in August of 22, which is basically saying, you're going to have pain, we'll get inflation back down to 2. And now they sense an unwillingness to generate economic pain to achieve inflation at 2%. And they're willing to just to stretch the timeline. Putting the emphasis on time to get to 2% is very different to putting the emphasis on pain to get to 2%. Isn't that a bit of a turn, a bit of a shift?
It is a little bit of a shift, though I would say in their defense, people were saying they were behind the curve, and people were saying maybe they should stop hiking earlier because of this lag effect. So you have some of this lag effect. And the other thing is, let's not forget, their favorite metric, PC, it's rarely above 2% historically. For much of the last 2 decades, it barely gets above 2%. So they picked a pretty easy metric that it's kind of in their favor. It should head down that way.
I'm pleased to say we've re-established the connection with the former Fed Vice Chair, Randy Quarles. Randy, thank you, sir. You were mid-thought and you got cut off. So if we can pick up where we left off, why you believe they're still committed to 2%.
Yeah, sorry about that. Just before this inflationary surge began, there was a comprehensive review of the monetary policy framework, and as part of that, the Fed reaffirmed the 2% inflation target. It would be very surprising, and it would not be good for the Fed's future credibility for them in the first inflationary surge after reasserting that monetary policy framework and that inflation target to say, well, 3% is close enough for government work, and so we're done. That would mean that the next time there was an inflationary surge with a new 3% target and inflation goes up to 9% and the Fed says we're headed back down to 3, the folks would say, well, last time you said you're headed back down to 2. Why should we believe you now? So it's important for the Fed, and the Fed has been quite consistent in communicating that 2% is the inflation target. I don't think that inflation has to come all the way down to 2% before the Fed starts easing. But it has to be their preferred inflationary target measure, which is core PCE, has to have come down much closer to 2% and have stayed there for a while. And the other factors in the economy that could be inflationary, particularly tightness in the labor market, have to have adjusted themselves enough for the Fed to feel comfortable cutting.
I guess one question I have is, in the markets, he took the time back in the fall to mention the market had done a lot of his work for him. You know, treasury yields were at 5%, equities were weak, credit spreads were a little bit wobbly. Now, all of a sudden, you have yields back to, 4.25% roughly. You have equity markets doing very well, credit spreads are very tight, and he chooses not to mention financial conditions. Is that a signal or just how he's thinking about it? That, I think, is confusing me and seems to be pointing to a person who really wants to be dovish.
So I think you've got, we're at an inflection point in the Fed's policy path and in Fed's communications. At the outset of this process, there were 2 hypotheses: that interest rates wouldn't have to go as high as they traditionally have in the past in order to contain this inflation, a variety of reasons for that, and that interest rates wouldn't have to stay as high for as long in order to contain this inflation, a variety of reasons for that. I think the first of those hypotheses has been borne out. Interest rates, the Taylor rule, for example, a guideline that central banks around the world have used to guide interest rate policy, would have suggested at the outset of this you needed short-term interest rates of 9 or 10%. We didn't get there. Inflation is has significantly subsided. But the second hypothesis was wrong. It's going to take a longer period of time than many of us, myself included, believed at the outset of this for policy to do its work. Now, at the outset of the process, it was clear that interest rates had to go higher. Not clear how high. Interest rates had to stay high for a while, not clear how long. And so everybody was agreed we at least have to do something. We're now at the inflection point where there will be differences of view among the committee and therefore different communications from the various members of the committee. And the job of the chair is to try to maintain a consensus and direct that committee to an outcome, which complicates his communication task as well. So it's going to be confusing, and people will, I think, take wrong signals by hearing what they want to hear as the tone of the messages from the various Fed communicators begins to.
Randy, this was great. One thing we have to do is we've got to do this again because we've got to go. My apologies about the technical connection, sir. Randy Quayle's there, the former Fed Vice Chair. Peter Cheer, thank you, sir. Love this over the last hour. Appreciate it. Coming up on the programme tomorrow, Troy Gajewski of FS Investments, Kathy Jones of Charles Schwab, David Leibovitz of JP Morgan, and Lorena Urici of T. Rowe Price and Bramo back in the chair, I'm pleased to say, after a long weekend. From New York City this morning, good morning. This was Bloomberg Surveillance.